Okay, one more day. Here's our group event tonight. For those who weren't here yesterday, take a picture. We're having a group event from Macro Perspectives, like we do every year. So if you didn't get the information yesterday, get it today. For those who are new, first 5 minutes, no questions. Last 5 minutes, no questions. Code of conduct's in effect, and that's everything, right? I think so. That's it. Perfect. Adrian's up. Oh, and talking to the microphone because people have got to hear us. Another microphone in the back.
Right. So thanks so much for having the paper on the program. So it's a joint paper with Tom, Matt, and Ludwig. Ludwig's on his way. Tom and Matt stayed at home with their babies. So I'm the only representative of the team so far. Don't be too tough. Okay. So the new Keynesian model, that's our workhorse for the effects of monetary and fiscal policy. Kind of ships in two versions. There's the 3-equation version that you can use for intuition or for analytics. That's a model in which consumption is a single component of aggregate demand. Think Clarida, Galli, Gertler, Woodford and Galli's textbooks, and so on. And then there is the version that you use for quantitative analysis. That's a version that at the very minimum is going to include investment as an additional endogenous component of aggregate demand. Typically, you also get these other bells and whistles, right? So think about Christian Reichenbach Evans, Mess-Waters, and so on. Okay, so all this literature builds on this twin assumption of representative household and a representative firm. And of course, as everybody in this group knows, you look at the micro data, everything you see is heterogeneity. And so you look at household data, you see heterogeneity in income, wealth, consumption. On firm data, productivity, size, leverage, investment, and so on, right? And so that leads to a supernatural question, which is that of whether this heterogeneity actually matters for the aggregate effects of monetary and fiscal policy that the new Keynesian literature has been thinking about. And for the consumption side of the literature, I'd say it's fair to say that we actually know the answer, right? We have a pretty mature Hank literature. So this is Ben, Gianluca, Greg, some of the work I've done with Matt and Ludwig, and so on. Many others in this room have contributed to this literature that's asking the question, okay, let's think about household heterogeneity. How much does that matter for the aggregate effects? And if you want a high-level summary of this literature, I'd say, if you take the empirical level and heterogeneity of marginal propensities to consume into account, you put that into the model, then monetary policy transmission to consumption is going to rely a lot more on these so-called indirect effects. And then deficit finance fiscal transfers have much larger aggregate effects on consumption. Right? So contrast this with the investment side of the literature, where there is no similar answers, right? There is, of course, work that integrates firm heterogeneity into new Keynesian types of models, right? But that's mostly literature that has focused on the heterogeneous effects of policy. So you could think of this as the first step, which is, okay, first step is if monetary policy changes, that affects firms differently, and we know that part. But we don't really know how much that feeds back into the aggregate or how much that affects the overall transmission to investment. And that's kind of surprising because investment actually in these CEE type of studies, it actually accounts mechanically for at least 50% of the total output effect of monetary policy in the data. So in other words, it's a very big component, a very big reason for why aggregate demand is moving in response to monetary policy changes. And so what we're proposing to do in this paper, which is in preparation for the Journal of Economic Literature, is we just want to bring firm heterogeneity into Hank in this way. In other words, just thinking about how firm heterogeneity matters for the aggregate effects and use the types of lessons that we've learned from the literature at the top to think about investment, okay? And what I'm going to try to convince you of is that actually, if you think about it in this way, you could see that firm heterogeneity really does change policy transmission a lot, just like for households, and actually for very similar reasons. So you can kind of import a lot of the knowledge from the first literature into the second, and you're going to find very similar things, okay? So what we'll do specifically is we're going to write down a heterogeneous firm model that's going to have adjustment costs and financial frictions, right? So the adjustment costs, that's something that's known to be needed to mute the aggregate effects of monetary policy on the investment in the first place. So that's there in Christian Reichenbaum and Evans and all that literature, right? It's just to slow down the effect of monetary policy on the investment. The financial frictions are going to be there to bring in these new interesting mechanisms, right? And the key in this model is going to be that our financially constrained firms, just like financially constrained households, they're going to have positive marginal propensity to invest, which we're going to define in a very parallel way to the MPC as the amount by which a one-time transfer of $1 increases your investment today. Okay? So that's going to be our definition of the MPI. And we're going to write down this model, we're going to calibrate it, we're going to get a distribution of MPIs in the calibrated model. And given this distribution of MPIs, we'll find that monetary policy stimulates investment through indirect effects, like these cash flow type of effects, right? Think monetary policy changes aggregate sales. Aggregate sales is boost aggregate cash flows, and then firms invest out of additional cash flow. And also we'll find that definite finance fiscal transfers to firms have large aggregate effects on investment. So you see those two big messages from the household literature are just totally portable to the investment literature. But different from MPCs, and this is where we think of this as a kind of a call for research in this literature, is we have a very limited amount of evidence on these marginal propensities to invest, right? And in particular, we have no direct evidence on the entire distribution of marginal propensity to invest in the data. And so we think that there's a lot more empirical work that's needed to discipline these new mechanisms. And I'm going to show you a couple of examples where this shows up, where we're going to be like, we don't know if this is true or not. That'd be really interesting to find out. Okay. So here's my plan. So I'm going to start by just kind of a brief review of both Rank and Hank. Okay, so we'll start with policy transmission in a model that has both a representative household and a representative firm, just to kind of set the benchmarks. And then we'll say, let's add heterogeneous households just to see how much the transmission mechanisms to consumption change. And then we'll add heterogeneous firms on top of it, right? So have a model that has both sources of heterogeneity. And we'll think about transmission mechanisms for investment. And then a very natural question you're going to ask at this point is, well, what did it matter that you had a model that had both things at the same time? And I'm going to say yes, right? So I'm going to show you that there is a complementarity from combining household and firm heterogeneity that you don't get from just the model that just has the heterogeneous firms. Okay. All right, so let's start from the representative agent model. So this is going to be infinite horizon, perfect foresight model, where we consider small date zero MIT shocks, right? So we're going to do first order perturbation, right? Note in the light of the discussions that have been occurring over the past week or so, it's also interesting for us, and it's something we're going to do, look at large shocks and how different they are from small shocks. Okay, so our representative household solves this totally standard objective function, right? Maximizes the classic kind of separable utility function over time, receives wage income, receives dividend income, and potentially gets some transfers. These are going to be lump sum transfers, these TH, lump sum transfers to households. And our representative firms produces using a standard Cobb-Douglas production function where we allow for diminishing returns in total, right? So this alpha plus nu could be less than 1. And also, we add these capital adjustment costs. So like I said, we know in these new Keynesian models, we're going to need some kind of adjustment cost to slow down the effect of monetary policy on investment, right? So these are going to be, this fee over here is just a capital adjustment cost, and we're going to calibrate this to be quadratic. So think of this as Q theory, okay? So the firm maximizes the present discounted value of dividends, where dividends are output net of the wage bill, net of investment and these costs, plus potentially also some transfers that it might be getting. And so here we want to think also about what happens if we do lump sum transfers to firms. Okay. Now our firms, we're going to assume that they face flexible prices and perfect competition. So on the firm side, there's flexible prices, and firms are on their labor demand curves, right? So they're equating the marginal product of labor to the wage. And the stickiness is going to come from nominal wage rigidity. So this is kind of something you might be used to from the type of models we've been writing, right? So we have sticky nominal wages, they're reset a la Calvo, right? That leads to this linearized wage Phillips curve. And monetary policy in our benchmark is going to follow this real interest rate rule, where we're going to shock the intercept of the rule, right? The R star is the intercept to the rule. And so I think there's a shock to R. And then monetary policy just has this rule where there's these intercept shocks, and otherwise it directly targets the real interest rate. Okay. Yeah.
The RS on the
Yeah.
the RS on the previous slide.
Yeah.
Can you just say a bit about what that is and why?
So why are we taking the present discounted value of dividends at the sequence of risk-free rates?
Yeah,
Yeah.
was the RT or RT star or there's two other R's that.
Well, so the R star in equilibrium, the R and the R star will be the same, right? Because this is actually, so just think of this as R star is actually the equilibrium real interest rate in this model. It's also the shock, right? And then why are we discounting using the present discounted value at the sequence of risk-free rates? That's because there's perfect foresight, right? So there's no other way to discount, right? There's no kind of ambiguity as to what the discount rate is.
I guess that's a question for the heterogeneization.
Uh-huh.
What is going to be the best discount factor that you're going to use?
So in the heterogeneization models, it'll be the same. So, right, so we'll still have perfect foresight, and we are always discounting at the R. That's
That there at the point is about this.
so yeah, let's
ask the question.
just wait until we get there. So there's two ways to write this model, right? So here, look, I mean, here there is only 1%, so there's not really ambiguity. You get the dividends, and then you discount at the R. Later, what we'll do is we'll have the firms be traded on a market, right? And so then there's going to be kind of a stock market, and so because there's always at least somebody who's on an Euler equation from today to tomorrow, there's always an arbitrage condition which involves the risk-free rate.
So I have a simple question. So it's the fact that the shock is going to be a change in the interest rate. Is the fact that you don't have that variation there?
I don't know what you mean by we don't have that variation. The shock is a shock to the R, and it definitely changes discounts. Yeah, so it's just in equilibrium. I have R and R star. This is just to be clear about what the shocks are. In equilibrium, the R and the R star are the same. Yeah, and so for sure, what happens? One of the things that happens as monetary policy cuts interest rates is it raises stock values, right? It raises the present discounted values. Yeah. Great. Okay, so fiscal policy here is going to set a path for transfers. So this is not fiscal theory, right? We're going to set a path for transfers that has present value 0, right? Now, here we're allowing for a totally arbitrarily split between household and firm transfers, right? So we just say, you could, for instance, give a transfer to firms and then raise taxes either now or in the future on households, right? So we allow for any specification of fiscal policy such that the present discounted value of the transfers that you give is 0. Okay, that's going to be our fiscal policy. And then given monetary policy, so this R star, and given the specification for fiscal policy, we're going to define an equilibrium as usual as a sequence of prices and aggregates, such that the good market clears at all times. Okay. So how are we going to calibrate this model? We're going to use standard functional forms, quadratic adjustment cost on investment. And then we're going to set kind of the standard curvature and depreciation parameters exogenously, beta to hit 1% quarterly real interest rate. And then we have 2 parameters that we set to hit in the spirit of Christian Eichenbaum and Evans, but of course not the details, to hit the impulse response to a monetary policy shock. So that means we set the elasticity of intertemporal substitution to hit the peak consumption response and the degree of capital adjustment cost to hit the peak investment response. This is not a model that has all the bells and whistles. We're not going to be able to hit the hump shape, okay? But we do this so that the relative consumption versus investment response is right relative to the data, right? So just so you see what it is, on the left is the impulse response to an AR1 type of monetary policy shock calibrated to the CEE type of effects you get on monetary policy. So you get a 1% increase in investment and about a 0.2% increase in consumption. This is consistent with what we get from them when we just look at the peak. Right now, we don't get the whole hump shape, of course, because we don't have all these additional things, but we get that 0.2 and that 1, right? And so what does that mean for the aggregate effect on output? It's about an increase of about 0.4%, right? Well, why is that? Well, consumption is 80% of total output, and it moves by 0.2%, and then investment is 20% of output, but moves by 1%, right? And so that means that investment accounts for 60% of the movement in aggregate demand in this model. Okay, so it's investment is small as a fraction of output, but it's very volatile, and we capture that. Okay, so that's the calibration. Now we're going to do transmission mechanisms to both consumption and investment. So for consumption, we're going to take it straight out of Kaplan-Maull and Violante, right? So this is the representative agent model. We'll say, what are the transmission channels to consumption in this representative agent model? We have an intertemporal substitution channel, and we have an income channel. The income channel is going to be multiplied by 1 minus beta, so this is the MPC, right? So this is going to be tiny. and the intertemporal substitution channel is going to be most of it. Okay, so that's just exactly the same as Kaplan-Meier-Violante. We just have the investment on top. For investment, we'll do the same. So we'll say, okay, let's do a first order decomposition of investment into the two channels that are driving here. So what are these two channels? Okay, so this is Q theory. So there's two channels also. One is a discounting channel and one is an MPK channel. Okay, so what's going on here in these formulas? Well, so you have Q theory, right? So the investment response is proportional to Q. And then when you're lowering interest rates, right, you raise the value of firms, so firms will want to invest more. And also, to the extent that you raise the marginal product of capital in the future, firms will want to invest more. Now, in this model, the MPK is directly related to the wage. Right? So if the wage goes down, firms hire more, then their MPK is higher, then they want to invest more. Okay, so we can actually decompose the effects into an effect that comes from the wage and an effect that comes from interest rates. Right? And so those show you the neoclassical effects, right? This discounting effect and this expected MPK effect, right? And so then in equilibrium in the sequence space is going to be given these R and these T's, a sequence of wages such that the market clears, right? And so here it's interesting to just think about the effects for a minute because this is going to come up again. So what is going on? This is a sticky wage model. Suppose you have a monetary policy impulse response, so an accommodation, right? Interest rates go down. So then households bring forward consumption, so consumption goes up, and also because these discount rates go down, firms want to invest more. So aggregate demand goes up by more than supply. And so we're trying to induce firms to produce more here. How do we do that? We lower the wage, because lowering the wage makes firms want to invest more, right? So initially, the real wages go down. Right? Aggregate demand is higher than supply. Real wages go down to bring that back on balance. But then firms invest. And so you've got this other thing, which is not there with consumption, which is as firms invest, they build capacity. There's more capital installed. And so now we have more supply. And so later on, the kind of the sugar effect from monetary policy goes away. Firms have too much supply. So actually you have to bring supply back down and real wages have to rise. Okay. So this is the pattern you see over here on the left side, right? You see real wages initially fall and then rise to bring about the effects I showed you earlier, right? So consumption goes up, investment goes up, and it's a pattern where wages first fall and then increase. This matters when we think about the MPK, right? And so let's kind of do this decomposition, right? So on the middle panel, I've got the consumption decomposition. This is the usual effect from Kaplan-Meier-Violante, where in the representative agent model, almost everything is from direct effects, tiny from indirect. But then the conclusion actually is the same or even more accentuated for investment, where more than 100% of the effects on investment here are from direct effects. You do have some small indirect effects from the wage, but here's the logic. The firms are super forward-looking. They don't care just about the MPK tomorrow. They care about the whole sequence of MPKs. And they're thinking, okay, well, in about a year, the real wages will rise, right? And so my workforce will be lower. My MPK is lower. I want to invest less, okay? So the effects that go through the wage in these models, they're super forward-looking and kind of a little bit counterintuitive, okay? The effect that one might have in mind is, oh, well, maybe if wages go down, firms make more profits, they invest more, right? But there's nothing like this in this model. Firms are on a first order condition, and there's nothing that links their wages to their investment, okay? Their current wages to their current investment. Okay, so of course, yeah, but
Why do you find the indirect effects on investment as working through wages as opposed to, I would have thought you're going to do like through sales or something? Right, if you go back to the previous slide,
yeah.
In the bottom, in the last equation, I mean, I guess you have I as a function of R and W. I guess I would have thought you were going to, I mean, in line with how you defined this MPI in the introduction, I would have thought you were going to somehow have I as a function of R and I don't know, Y or something.
Yeah, but this is the neoclassical model, so it doesn't work like this. So like I can't do that. So we're going to see this in a minute when we introduce the model with financial frictions. Then we will be able to do this. And so there is going to be this channel from sales. But in the neoclassical model, it really is just the expected sequence of marginal products. And so there is not really a way to link it to sales because ultimately it is back to, it's the MPK.
It's not the neoclassical model.
This is the Q theory model. Yeah. Sorry.
You've also got the rigidities.
So the rigidities, so these decompositions hold no matter what the underlying GE structure, right? And then it's just that we have the rigidities such that we can lower interest rates, and they have, if you know, it has all the sort of usual effects. But these two equations over here, right? I mean, as you know from the stop equation, right? It has nothing to do with nominal rigidities per se. You can derive it anyway. And the bottom is the same. It's just Q. It's basically linearized Q theory. So this just says, what does Q theory tell you? It tells you there's these two effects, and the effect on investment is through the expected MPK, right?
That makes sense. It's just, there's a bit of a tension between these equations
Yeah.
and the words you use.
No, and that's because I'm trying to set up that tension, because I want you to think this is not really the right model of investment. Right? This is the Q theory model. It misses something, and yeah, just like the representative agent. Yeah, you say, well, the representative agent has way too small indirect effects compared to what we know about MPCs, and this effect, notice, you can ask yourself, how much goes through MPIs here, and the answer is 0. Right? There's actually, in fact, the MPI is 0.
So that's different from consumption, right? But
Yes.
in consumption, even in the rank model, it's like there is still an effect through the NPCs. It's just one.
It's just the MP.
It's like 1% or something.
Yeah. I could have added
99%.
plus MPI times stuff here,
I see.
but MPI is 0 here. Yeah. Maybe this is the most direct answer to your question. Yeah.
Can I ask just a question? So in the flex price version of this economy, can you say what would those aggregate and decompositions look like?
I mean, off the top of my head, there's like the wealth effects on labor will matter a lot. It's a little bit hard to know, like specifically depending on what the functional form is for, you know, consumption versus labor. So what I can tell you is for sure it'll still be like these equations will still hold, right? And also that these MPK effects tend to be small compared to the discounting effects. So provided that you get the discounts to move a lot, that's going to depend on things like the interval substitution, but provided you get the discount rate effects to move in the flexible price model, you're going to basically have that totally dominate the investment response, and the MPK effects just will be small. That's a general statement about R effects versus MPK effects. And then the other thing, I guess, which is just universal, is that the MPI in a model like this is 0, because what determines investment is the first order condition, right? So it's nothing at all about budget constraints. In fact, there is not really a budget constraint for firms here, right? Firms never have any problem, say, raising funds, right? If they want to invest more, they just get the funds from households, right? And this is where we're going to need the financial frictions, right? We're going to need financial frictions to kind of stop that ability of firms to just raise funds at any point whenever they want to invest. Okay, thanks. This was useful. Okay, so yeah, we're going to say that contrast this with high MPCs that have income. And also what I want to say is non-zero MPIs that have cash flow. We have a little bit of a literature review here. I think the literature agrees that when you give firms transfers, they invest more. There is just generally too small samples to really be able to tell what the magnitude is, okay? But the MPI is 0 in the model and it's non-zero in the data, right? Okay, so here's another place where this shows up a lot. Aggregate effects of fiscal transfers. So if you do debt finance fiscal transfers, paid for by, say, lower future transfers, to households, there's no effect because of Ricardian equivalence, right? So this is well known. To firms, there's no effect because the MPIs are 0 in this model, right? So sometimes people say this is inside and outside liquidity are the same, right? So money on the balance sheet of firms or away from the balance sheet of firms is totally irrelevant. Now, firms can always raise funds from households here, right? And there's no cost to doing that. So the MPI is 0, right? So we're going to want to build in these non-trivial MPCs and MPIs consistent with the microdata. And so we'll use heterogeneous agent models with financial frictions for this. So this is our motivation for the type of model we're going to use on the firm side, right? This financial frictions. Okay. So let's reevaluate the effects on monetary policy and fiscal policy in light of these models. So we're going to do very quickly, Hank. Okay.
Sorry, one more
Yep.
question.
Yep.
I guess you could have also written a rank model with financial frictions as opposed to
Yes. And so this is where my last part will come into play, where I'll say, did it matter that I have Hank and heterogeneous firms at the same time? My answer will be yes, because of a complementarity. So I'm going to show you, I'll have that version of the model, and then you'll see, okay, how much did it matter to have both at the same time? Yeah, great. Okay. So for Hank, so we're going to get these MPCs from the classic idiosyncratic income rates, precautionary savings, and borrowing constraints, right? So here we're going to have households we have a one asset, one account model, right? So, but beta heterogeneity, so we can hit at the same time the MPCs and the level of wealth. Households now, notice we changed the financial market structure a little bit so that we can include these traded firms, right? So we have households, they own this mutual fund, the mutual fund is going to own the firms, and then they get directly the wages, they get the transfers, right? And then the RP here, that's the ex post return on our portfolio of firm shares and government bonds. So we're going to have these two assets in the model, shares and bonds, and the representative from shares now are traded on the market. And so this is where this is where you get the equation that the price is the present discounted value of the future dividends. Okay. So obviously these two market structures are totally equivalent in the representative Bayesian model, but here it matters to have them, the firms being traded. And then we're going to calibrate the income process to microdata, set beta to hit aggregate assets and MPC of 0.25, right? And so here, of course, as everyone knows in this room, right, there's this trade-off between hitting MPCs and hitting assets. And we resolve this with beta heterogeneity. We don't think it's essential. We prefer the Kaplan-Maull-Violante way of doing it. It's just that it's more complicated and sort of not essential for this paper. Okay, so let me show you just briefly steady state policies, MPCs, and distribution, just to set up what we're going to see in the firm model, right? So here in this model, you've got this buffer stock behavior that households follow, right? So this shows you the policies of households as a function of incoming assets, right? So the red line is a household that has relatively high income. And what you see is, so it's a declining net savings policy. So as agents have higher assets, their net savings goes down. And what that tells you is that they have this buffer stock target for where they want to go if their income just stays at this medium level, right? And they're going to want to go to this A star, right? So they're above, they'll decline. If they're below, they'll increase. And the reason why they do that is because they're worried about going down, say becoming low income here, right? And so they'll have this target, this buffer that they can then draw down on in case their income goes down. So their savings will go down, and that'll prevent their consumption from falling too much. And then they're going to go to zero here, right? So here their target in case their buffer stock target in case they have low income is zero, right? And so they're going to all the way eventually to hitting the constraint, right? So you get these kinds of policies with these target stocks that generate an entire wealth distribution of agents, right? And on the right, we look at that plotted. So this is the gray bar lines plotted against the distribution of MPCs, right? And so here you see the MPCs are very high at the bottom, and then they decline, right? So you get the concave consumption function, and our MPCs are negatively correlated with cash on hand, okay? So this is sort of what's behind in the background of this model. And we're going to see that in the firm model, things look almost exactly the same, okay? So this is going to be kind of interesting. Okay, what about impulse responses to monetary policy shocks? So we just take this Hank model, we do impulse responses. So in the middle, we have the consumption decomposition now. Remember, so every time we introduce a new model, we recalibrate the model to hit the same level of the consumption impact and the investment impact. So don't read anything into the aggregate effects here. The model is recalibrated to hit the same everywhere. Okay, so this is about the decomposition here. Okay, so the decomposition is, as Kaplan-Maull-Violante showed us, just much more heavily leaning on these indirect effects now, right? Why is that? Well, because the MPCs are higher, right? So the reason why consumption move is, here it's about 60-40, the direct versus indirect effects. So you have these big indirect effects because wage income goes up, dividend income goes up. In fact, I mean, here, wage plus dividend income is proportional to output here. So output goes up, and then all these things go up at the same time. And then households have MPCs out of those things, and that increases their consumption. What about investment? Well, we haven't changed the investment side, so nothing changes on investment so far, right? So we have exactly the same effect, aggregate effects, and also same decomposition. I'll say here, the magnitude of the indirect effect of consumption is controlled by the income-weighted MPC. It's like the general equilibrium effect, so it goes through the income-weighted MPC. That's going to have a parallel for firms. We do have, just very briefly on this, we do have to recalibrate the model, right? So if I had done the same thing with the same parameters, I would have had a bigger effect on consumption. That's because there is an effect an amplification effect when investment goes up, output goes up, so then consumption goes up. So if you didn't recalibrate the model, the aggregate consumption effect would be higher, but we're removing that effect here by recalibrating. What about household transfer shocks? Household transfer shocks have these big effects, right? So they're big and persistent, right? So if I do a one-time transfer to households, because they have these intertemporal marginal propensities to consume, you see the direct effect of that is persistent effects on consumption. And then in general equilibrium, this feeds back into higher income and therefore higher consumption. And so you see this very persistent effect on consumption, right? But in line with what I was telling you earlier about the MPK, right? The MPK effects are small here. So it's true you get a boom. And so firms need to hire more. So there's a little bit of a movement in their MPK. But that effect is really tiny, right? So basically investment doesn't move at all because of this, right? So there's a boom in consumption, there's more sales, firms make more profits, but they do not reinvest those profits. They just look at their MPK has barely moved, so they don't really move their investment. Okay? Still almost no effect on investment. Okay, so let's just introduce firm heterogeneity. Okay? So what we're gonna do is we're gonna build on that sort of firm heterogeneity tradition of models with idiosyncratic productivity risk, entry and exit, and financial frictions. Okay, so the model looks a little bit more complicated, but it basically is the model that I showed you earlier with added heterogeneity on Z, on the productivity, right? So relative to the hustle model, these firm models, typically they're formulated with two continuous state variables, which are capital and bonds, right? So there's the capital, K, and bonds, B, which is the level of debt that they have, right? And so they still maximize the present discounted value of dividends, subject to, so the dividends are just the same as what I had earlier, but now I'm letting them have another source of financing, right? So think of dividends as equity financing. Negative dividends would be you bring in, you issue equity, right? Positive dividends is you pay. And also you can also finance yourself with debt, right? So this is the B, right? So I'm letting these firms borrow potentially. They borrow subject to a financial friction. And the financial friction is two-sided here. So there's a maximum amount of borrowing that's related to their capital, right? So there's a leverage constraint. So you can only borrow a fraction chi times K prime. But also, I'm preventing you from paying dividends at all, right? Because if I didn't have this other friction, then you could always just issue equity, okay? And so we're preventing you from issuing. There's some friction that prevents you from issuing equity, and then some friction that prevents you from borrowing too much. And so these are the two constraints in the third line, right? And then I have one more feature here, which is exit. Now, why do I have exit? Well, these firms, there's no curvature here. There's no kind of natural reason for these firms to want to stay away from or no impatience, no natural reason for firms to stay away from constraints. So if I don't kill them, they're gonna go to the region where they're totally unconstrained, right? And so you get exit to prevent them from growing out of constraints. Okay, so these are the four features of this model. Yeah, Xavier.
So if you put some form of interest rate to be constrained to the discount the value of the target, would you call this effect a direct effect on interest rate on investment, or the other way to model the constraint?
So okay, so there's two things on this. So suppose you're at the constraint. So it's true that, say, if interest rates go down, the sort of effective payment on the borrowing limit go down, and so there is like a cash flow effect from low interest rates here, right? So that's there, right? So that's from this B prime over 1 plus R. So you are borrowing at the market rate. It's like short debt. And so there is an effect from monetary policy to cash flow through interest rates, right? That's there. The other thing you were asking about is, I guess, about the form of the constraints. So here I just have your B prime going out must be less than the K prime that you're borrowing. That's preventing one effect, which we think is quite relevant, which is the effect that asset prices might have on your collateral constraints, right? So like a Kiyotaki-Moore kind of effect. It's not supernatural to put it into this model because there isn't really like a secondary market price for capital. And so there is not like a natural, what's the value of my assets? And, maybe interest rates relax the kind of market value, and then I could invest more. But that would be an additional channel, right? That'd be like a Kiyotaki-Moore type of amplification effect. Lower interest rates, relax collateral constraints, and then firms are able to borrow more. We don't have that directly here, right? Because the way we've formulated the constraint.
The Z process is only idiosyncratic, or is there aggregate shocks to the Z? And I just wanted to
So in this model, we're not shocking aggregate productivity. We have idiosyncratic productivity shocks. That's going to be the source of churn in this model. So just, I'm going to show you this in a second, but it's just like for households, there's churn because of idiosyncratic productivity risk, which makes them want to move, you know, to the constraint and away from the constraint. Here it's going to be the same thing. There's going to be sources of churn because their target stock of capital is going to move around, right? But we don't have direct shocks to productivity. That's not hard to do though. So this is just because we're focusing on monetary and fiscal policy. You could imagine, you know, the production function is little z, k alpha, n nu. Just throw in like a big Z T that moves with time, that's aggregate, and then you could study productivity shocks. So it's not, it's just that we're focusing on these other two shocks, but that's not a restriction of this model. Yeah.
A couple of comments. First, with respect to my first question, I understand that because you have this, essentially you don't have any aggregate shock, then you don't have this problem of aggregating stochastic system factor. Okay, so that's what you're gonna have it as soon as you produce. I mean, it's everybody. So
Yes, yes. So if, yeah.
You know, how to discount.
Absolutely. Yeah. We're not solving this long-standing question in general equilibrium theory, which is if you have incomplete markets, how do you discount the firm cash flows? Yeah. So there is a stock market helps us here, right? Because the stock market says, well, at least they trade on a stock market. So there's sort of, you know, there's sort of some common ownership, but of course the people, you know, the stockholders have different SDFs. Yeah. Yeah, totally. So the way we would do it actually related to all our work on portfolio choice is that we would probably just effectively have equalization of SDS for the traders based on some choice of portfolios. And so we let them, will be like a complete markets on the, you know, on the aggregate versus aggregate shocks, just so that it would be like clear how you would do it. Right. Yeah.
The other question, I'm not sure, did you talk about what size of in this, it's still a convex function?
So phi is still quadratic adjustment cost. Yeah, so we're not changing relative to that. Yes.
So
Yeah.
I mean, there is a large literature
Yeah.
suggesting that, you know, investment adjustment cost on the micro level very far from the convex.
Totally.
Fixed cost.
Yeah.
And that would have a really big impact on
Yeah.
the marginal risk to invest. And the effect that, you know, if you give $1 to a firm, maybe in an actual region, I mean.
So there will be an inaction region. So great. So thanks so much for this comment. So this is actually a super important point. So actually talking to Tom, you know, we said, we want to write a heterogeneous firm model. What should we do? And he said, there's basically two models we can write. There's a model with financial frictions, or there's a model with fixed costs. Okay? And there are just two big traditions in the literature. It was more immediately clear what the financial frictions would do because they raise these MPIs. Right? The fixed costs, I say two things about it. First of all, it'll create much bigger nonlinearities, as you guys know, right? So this will mean that there'll be an inaction region, and then probably small transfers won't do anything. Big transfers will do a lot. So that's one thing. So create a lot more nonlinearity. It's not totally clear that it'll change the sort of average MPI, but it will definitely create much bigger nonlinearities. And the other thing, which is actually from work by Kobe and Wolf, and some work actually also by Tom, is that if we just had the non-convex adjustment cost, let's say a fixed cost, right, as opposed to the fee, then that model would have way too large sensitivities to interest rates. So we would probably need to have the quadratic on top, right? So it's not that it would be a substitute, it would just probably be added to this model, right? Because otherwise the elasticity to the interest rate would be way too big, and we're back to the problem for why we added the quadratic in the first place, right? And that's, I think Kobe Wolf paper had a nice, you know, illustration of this. It's like, if you just have the fixed costs, but not the quadratic, then you have way too large elasticity of investment to interest rates.
They can add with respect to the choice of financial friction versus fixed cost. Another argument is that it's more symmetric with the household side. So the function, so you know, it's so all the parallels that you wanna draw, and that I think is very useful in drawing the parallel between on the first side and the household side. I mean, this is the natural first step.
Right. Yeah. So, but I totally agree with you that there's this other big strand of the literature. And so it's not that we're ignoring it. We're just thinking, okay, it's this first step to introducing heterogeneity. Think about Hank.
Can I just follow up on this just to understand? So, what did, in terms of what you just said, what does it mean for MPI? So if I understood you correctly, you said this model without the financial frictions would have an MPI of 0.
Correct.
Now, what if you add the fixed costs? Does it still have an MPI of 0?
So fixed costs plus these financial frictions, you still. Removing all the financial frictions altogether. No. Yeah, I guess I was thinking of it as like on top. Yeah, because
It's not like the fixed costs are an alternative modeling device to get.
I need to think about it, but I don't think so. No, I think the financial frictions are essential here, right? Because otherwise you can always just think of it as if there's no constraint on what the dividends are, basically there's no constraint on what investment is, you can always raise equity, right? And that's just a general property of these models. So yeah, so then the question becomes quadratic adjustment costs versus these fixed costs for investment in addition to the financial friction, right? And so this is where it,
But you would need only
yeah.
the non-negative dividends.
non-negative.
Those would be sufficient to generate positive NPIs. You don't need the borrowing.
So I think, I mean, in principle, if you could just borrow as much as you want, like you're almost on an intertemporal budget constraint, right? So it really does help a lot in this model to have the two-sided constraints. And in fact, I'm going to show you in this model, they're tightly related in the following way, that the B prime less than chi k prime constraint here, it's kind of like a shadow constraint that governs all your decisions, because the way you're thinking about it is, I'm not going to pay any dividends until I am sure that I will never hit that borrowing constraint, right? So the two are closely related. And I'm actually going to show you this. There's an equation that links the Lagrange multipliers on the two, right? So you could be borrowing unconstrained in this model, right? So you're not actually borrowing maximally, but you're not paying dividends because you're worried about the future borrowing constraint, right? So it has this kind of interesting relationship between these two things. So they're really tightly linked. So the two-sided nature of the constraint is quite important for this model. And so I think that carries over also to alternative models. Yeah.
There's a little, there's a little tension between, trading these companies in a market and being unable to borrow. I mean, if you think about, companies operate traded companies that are access to assets, essentially, from the evidence you cite, that are actually not borrowing constraint. A feasible alternative would have been is Agile household actually operate their own firms.
Yeah.
And so then the MPC and MPI would be more directly linked.
Right. So this is more the type of model that Ben was writing.
I think it's also doable.
Absolutely. Yeah. So this is more, there's kind of a question of whether these things are, they're traded firms or they're like really these little entrepreneurs, right? If it's a little entrepreneur, it's actually the types of models that Ben has been working with, right? Where you have the firm is inside the household and then those things are closely related, right? So here we're thinking about firms that they're like a little bit bigger than this, right? And that's right. I mean, I think those models are a little bit better understood, but I agree that we could and we should also consider just that version of the model, right? So here, what is going to actually happen in this model is that these firms are going to get like an initial equity injection, and then they're never going to raise equity again, right? And so they're more these kind of medium-sized companies. They're not like these big firms that raise equity often. Okay. Great. Okay, so we're going to calibrate this model, and the key thing about this calibration is we follow sort of what the firm dynamics literature tradition is of calibrating to things like the size of new entrants versus average firm. We don't have direct evidence on MPIs, so the way we would have calibrated a household model is what's the MPI, and let's just calibrate to that, right? So instead here we're going to calibrate to other things like exit rate and so on. In the model, the average MPI out of a uniform transfer to all firms is 0.5. Right? So it's really big, okay? Of course, ideally we could use this as a data moment. It's in particular, it's bigger than the MPC. It's double the MPC, okay? So it is really, really big, and that's going to matter a lot. Of course, we don't have these direct evidence, okay? So as I talked about this already, we don't have quite yet this, but since we circulated the paper, we received a couple of suggestions or papers that are trying to do either semi-structural estimation, as in BPP, or surveys to try to get the MPIs. So I don't think we're quite at the level where we know for sure, but please send us your estimates. Okay. So here's the steady state capital policy. So just to show you how close this model is to a household model, right? So the capital policy for this model, so this is even for an unconstrained firm, there's a target stock of capital. This comes from Q theory. Right? So the K star here for given level of Z is where you want to go given Q theory, right? And this is because this is the place that equalizes your marginal product of capital to the user cost. Right? And so firms that are below want to grow, firms that are above want to go down. And so that creates the churn once you have churn in Z, right? And the first order condition for these unconstrained firms, so what I mean by an unconstrained firm here, this exists in this model. This is some firm that has enough cash, right? So negative enough B, that firm is never concerned about financial constraints ever. And so it just follows the Q theory, right? And the first order condition is exactly the same. And in particular, there's the same two effects, discounting versus expected MPK effects. They're exactly the same as in the representative firm. Now you can consider the other opposite, which is a firm that pays no dividends and borrows maximally, right? So there are the two sides of the constraint. So that firm, its investment is purely governed by its cash flows, right? And so we have an equation over here that says your investment, your K prime, like how much the capital you're going next period, that just depends on current interest rate, current wage, and current transfer. So current interest rate is the effect I was talking about with Xavier, right? So if R goes down, you roll over your debt at a lower rate, and so you have more cash flow, you invest, right? If transfers go up, same thing. If wages go down, where your profits go up, you have more profits, you invest. So now your MPI matters for these effects, right? So this is and in fact, the firm at the constraint, it has an MPI greater than 1. So why is that? Remember, it's B prime less than K prime. So if I give you a transfer, you turn around, go to the bank, borrow 30 cents, and you invest 1.3. Right? So the MPIs are big in this model because of this reason. Right? Now, the overall policy kind of pays the two, right? So this is natural. So you go from a region where you're completely constrained to a region where you're completely unconstrained. And in the middle, you've got this multiplier dynamics I was hinting at earlier, which is the firms are thinking, hey, what is the likelihood that I ever hit a borrowing constraint in the future? And if you might hit a constraint, then you don't pay dividends, right? You prefer to keep cash in the firm because that's costly to raise equity. You don't borrow maximally though, right? And then you have intermediate MPI, right? So you're like a household that's not quite at the constraint, but they're worried about hitting the constraint. You have an intermediate MPC. So we're going to get a lot of intermediate MPI firms that they're just thinking, hey, I might be hitting the constraint in the future, and that's why I'm withholding. And in fact, if you look at the FOC here, you see that it's Q theory, but with a modified discount factor, which involves your change in your lambda, your Lagrange multiplier on your constraint, right? So this looks like the precautionary savings motive, right? So these households that they don't have any curvature. There's no third derivative of consumption, They don't have any curvature, but there's endogenous curvature through the time variation in the probability of hitting constraints, okay? And so that is like very much like the precautionary motive. Right, so this is your investment policy. You see, if you're actively constrained, this as a function of your distance to your constraints. So coming in, like how far are you from the maximal borrowing? And so you have an investment policy that looks a lot like a concave consumption function. A difference is once you hit a sufficient amount of cash, your MPI is exactly 0, right? So the slope becomes 0, right? You're at the first best and you don't invest more, right? So the distribution of MPIs is more spread out. At the extreme to the right, you have 0, right? These are unconstrained firms. And at the extreme to the left, you have more than 1 because these firms go and borrow and they lever up, right? So if you give them money, they lever up, they invest more. But otherwise, you see it looks very similar to a household model, right? So the declining MPI is a function of the distance to your constraint. And then in the calibration, you can move a lot of firms close to the constraint. The churn is very important here. So this is closely related to age actually in the model, which is how long ago they were born. Okay, so impulse response to monetary policy shock. You see the investment decomposition now changes, and we have this new effect, this cash flow effect, and it's a positive effect, right? So this is a little bit like the indirect effect from Capital More Violante. In fact, the magnitude of it, in total is similar to the indirect effect from consumption, but it is still small, and the reason is this in this model, right? The cash flow effect works like this. Monetary policy accommodates, wages go down, profits go up, and so investment goes up. Remember, the MPIs are large, but this is a general equilibrium effect that's going to work through size, right? So the small firms, their profits don't move very much, and so there's just not that much cash flow to reinvest, and the large firms have 0 MPI. So the thing that matters here for the indirect effects, these general equilibrium effects, is the profit-weighted MPI. That's a small number in the model, right? That's a place where we would like to know, hey, what's the correlation between MPI and size, right? Because that's going to govern the magnitude of this multiplier. Here it's small. We think it's probably too small, but we don't really quite have the data. What about a firm transfer shock? So this is uniform shock to firms where we give a transfer to firms. So now we have the big difference between inside and outside liquidity. These firms are going to invest basically like their MPI, right? And so this is going to be a very big multiplier. It's bigger than the multiplier on households, right? And you've got these transmission effects where if you transfer, so you give a transfer to firms, that raises aggregate demand, it raises income, and then households increase their consumption, right? And so this is where the complementarity I was talking to Ben about comes about, right? So we wouldn't have this additional effect, which raises the overall multiplier in the economy from transferring to firms, generating more sales, generating more income for households, and then generating more consumption, which then feeds back and so on, okay? So we get these additional things, right? Okay, so we have a table in the paper that we're pretty excited about. You could look at it. It just says, here is heterogeneous households and firms. If you read them side by side, you have all these things that are parallel, right? MPCs versus MPIs, prudence versus the constraint about hitting constraints, and so on and so forth, okay? And also in general equilibrium, right? Departure from Ricardian equivalence versus inside-outside liquidity, income-weighted MPC versus profit-weighted MPI. So this is just studying these two things in the same paper is useful, right? But the thing that I want to conclude on is you also get a complementarity, right? And the complementarity, you can read off this 2x2 table where you say, if I do a transfer to households, what's the transfer multiplier? In the rep firm head to household model, it's 0.3. Head firm head household together is more because of this C to I to demand mechanism. And then to firms, it's the same thing. So the way to understand it is, well, what's the Keynesian multiplier here? You go from MPC over 1 minus MPC to MPC over 1 minus MPC plus MPI, right? And so that's going to be bigger than the sum of the two, okay? And so you get this complementarity effect from this kind of additional term in the denominator. Okay, all right, so I'm just out of time. Thanks. So firms have been left out of Hank, but they have their right place there.
And it's, okay, so you gotta, what you've gotta do with it all.
Oh, yeah, you have taste shocks or something. No, my presence.
I hate them.
That's a search.
Okay, we got Jeff. Monetary policy without redistributed concerns. Take it away.
Good. So thank you so much for including our paper. It's John with Ariel, who's here in the audience, and David, who couldn't be here. Unfortunately, the title is Monetary Policy Without Redistribution. So the idea of this paper is to ask the question of what would a central bank want to do in a world where they're concerned about efficiency and efficiency only? Okay. So in this paper, we have to set up a bit what that means. So we're going to start by building a general heterogeneous agent New Keynesian model. And we're going to ask this question through the idea of an efficiency mandate. So general, we're going to include a bunch of the ingredients that this literature has emphasized. So sticky wages, sticky prices, incomplete markets, cyclical income risk. We're going to have multiple sources of shock. So we want to include a number of ingredients so that we can think about which things matter in this world. But the biggest departure from the literature is really going to be thinking about this efficiency mandate. So we want to think about a central bank that maximizes total surplus resources after, when it enacts a policy, winners can compensate losers. Okay, and in defining that, we're going to be building on my co-author's past work. And I'm going to guide you through the excruciating details of how all of that works. But let me just give you some of the reasons why I think this is an interesting objective to look at. First, it's completely invariant to to how you define utility functions. So going back to first year grad school, we all learned that utility functions are only defined up to monotone transformations. When you're defining a social welfare function, say like the typical paper in this literature would do, the social welfare function will embed some sort of cardinalization of utility functions. The way we define things is going to be completely invariant. And it will work very much like cost-benefit analysis, but it will also incorporate general equilibrium feedbacks. So the way to think about it is we're going to ask the question of, after I conduct a policy, is there a possibility of generating a Pareto improvement as winners compensate the losers, okay? And in doing that, that's just saying that after I enact a policy, there's a possibility of generating full consensus in the economy. Okay? So it's going to be similar in spirit to a number of classical papers, Calder-Hicks, of course, Allais, Zebro, and so on. Lots of people have done work on this literature, and that's how we're going to approach the question. Okay, so let me just give you a brief preview of what the results are. We're going to find that in this model, the incidence of aggregate demand fluctuations turns out to be key. Okay, the positive literature has also found that that's an important ingredient, and we also find it normative that's quite important. So if we have homogeneous incidence, we're going to find that even in the heterogeneous agent New Keynesian model, the policy is going to be exactly the same you'd find if you were to open chapter 5, 6 of Woodford 2003. With heterogeneous incidence, things turn out to be different. And the biggest thing that I'm going to emphasize is going to be dispersion of labor wedges, and I'm going to show you how that matters. Okay, so okay, good. So let me just give you a little bit more detail. So what's going on is that if we only have homogeneous incidence, the case where I just told you that the policy under the heterogeneous agent model just coincides with the same one as in the representative agent model, what's going on is that despite the fact that there's a lot of incomplete market losses, right? People are not perfectly insured against idiosyncratic income risk, and that creates a lot of efficiency costs. It turns out that monetary policy is not going to be able to affect those losses locally, okay? In a sense, monetary policy is too blunt of an instrument to provide insurance against those risks, and that's why the policy will coincide with what you'd find just in the Woodford or the Galli textbooks. When we move to heterogeneous incidence, there's going to be two new sources of departure from the rank policy. The number one is that by having heterogeneity in the incidence of aggregate fluctuations, monetary policy can affect who has what and therefore provide some insurance. That will turn out to be a short run force that will disappear in the very long run. There will be a second mechanism that is going to come from the fact that because of the heterogeneous incidence of aggregate demand fluctuations, whenever there's aggregate demand fluctuations, there will be a dispersion in labor wedges, and so output gaps are going to be more costly than the rank objective function would suggest. Okay? And that's going to be a permanent difference. Okay? We're going to find that in the long run, the first source of departure from the rank model dissipates, as I just told you. The second one stays. So actually, in the long run, the optimal policy is going to converge to just a dual mandate with a larger weight on output stabilization relative to what we would find in the equivalent representative agent model. Okay, so just in terms of the related literature, so we're very much building on the large literature that a lot of people here have contributed to on heterogeneous agent models and when and why do they matter. That went too fast. Good. Not good.
Even the computer wants you to skip the literature slide.
You'd assume that a year in Minneapolis would give me that. Okay, but I just want to emphasize one thing. So relative to, there's a long literature studying these type of problems in heterogeneous agent models, like what's the optimal monetary policy. Relative to that literature, as I've told you, the innovation is really going to be thinking about changing the central bank's objective. Okay, so we're not going to be writing down a social welfare function. We're going to be thinking about maximizing aggregate surplus in a way that I'll define. Okay, then in terms of our analytical analysis, you can characterize everything globally. It turns out that for the purposes of analytics, we can adopt the standard linear quadratic methods for analysis of optimal policy that also has a long tradition in monetary economics. And we derive this problem, and we have a companion paper where you can see how all of the gory details. I'll try to give you as much details are necessary for this paper, but really, if you want to find out the complete theory behind this, we have a companion paper where we go through all of that in a general model, not necessarily for a Hank model. It can be anything that you want to think about. Okay. Good. Okay, so the model. Let me give you a brief overview. So it's going to be what I would call a general Hank environment. So we're going to have a block of heterogeneous households. That's where most of the interesting action of this model is going to happen, and I'll give you the details for that in the next slide. Those heterogeneous households are going to be supplying labor to unions. The unions is where we're going to build the nominal wage rigidity. And instead of showing you all of the details that are standard, I'm just showing you directly what the Phillips curve for wages looks like. So the unions are just trying to close a gap between the marginal rate substitution. Inflation is also driven by expected inflation. And we're going to have there a wage push shock. So you see already two sources of shocks. So we have productivity shocks ZT and wage push shocks. So the wage push shocks are just going to be modeled as taxes on the firm's objective that then get rebated back, and that's our way of just capturing the standard wage push shock. Adrian, yeah. Sorry.
So you're kind of killing all the heterogeneity on the production side.
Yes.
That might add some additional.
That might add a lot of interesting stuff. We're keeping it simple by having it as just like the standard supply block. Yeah. I want to think about the heterogeneity in there and how the heterogeneity in there matters. And then if it shows up here, but when it shows up here, it will mostly show up as changing a little bit these coefficients. So
There would be a node.
but they could, yeah.
A related question, which is you're doing optimal policy analysis, so usually all the second order properties of the model matter, not just for the aggregate demand. So here you're linearizing your Phillips curves, but that's kind of just to show us the equations easily, or you're actually thinking those are the linear. You're doing optimal policy given those linearized Phillips curves.
Good. So as I told you, most of the analysis is going to be linear quadratic. So all the equilibrium conditions, we're going to be thinking about them linearized. You don't have to. It just turns out to be good and easy to characterize things analytically.
The one thing I don't see on this slide is like a fiscal policy or budget constraint. And I would have thought that the details of how taxes respond are kind of crucial for all of these issues, but the redistribution that comes in. So where does that show?
Great, absolutely. So I haven't gotten to the end of the slide, but let me just prelude what I was going to say by the end of the slide. I mean, general, as in there's a lot of ingredients. There's one that is missing, which is fiscal policy. We have not included it yet because we want to focus just on the other ingredients of the model, absent what just marginal taxes, distorting labor supply, and so on would have. But it's something that we plan on including at some point, but we haven't yet. We haven't gotten to that. So right now there's no government other than a small thing that I'm going to show you in the next slide.
So there's no assets and.
Assets are going to be zero net supply. Yeah. Good. Okay, so these unions, they're going to take the labor of the households, they're going to transform into labor service. They sell them to intermediate firms. Similarly, that's where intermediate goods firms, that's where the price for GDs are going to be. So there's just a standard Phillips curve that relates price inflation to marginal costs, expected future inflation, and again, cost push shocks on the firm side that are going to be independent drivers of inflation. And then those intermediate goods firms sell intermediate goods to the final goods producer that aggregates them according to a CES production function and sells them to households. Okay, so that's the overview of the model. So policy, as I was just describing, as I was just discussing with Greg, there's not going to be a government up to something I'm going to show you in the next slide, but there isn't really any income taxation or any government spending to finance. So we're going to be abstracting from that side. There's going to be, I keep clicking this. There's going to be policy. So we're going to be thinking of a central bank that is setting time and state contingent interest rate policy. So I'm going to be describing as just little IT, but really because there's aggregate risk in this economy, that's actually a function of the entire history of aggregate shocks up to time t, right? So that's also state contingent. I'm just dropping the notation to make things simple. Okay. So I said there's going to be multiple sources of shocks. In a sense, we want to include as many shocks as we can, just to think about which ones matter, which ones don't. Like that's kind of the philosophy of the paper. So here you see productivity, the push shocks, and then I'm going to show you a source of financial shocks or demand shocks in the next slide. So let me turn to the household to exactly show you that. So the households, they're going to be a standard Iagari type incomplete market model with idiosyncratic income risk. So household age as productivity ZHT at time t. We also have boring constraints. They're going to have some preferences, some preference relation over stochastic paths of consumption and leisure, LHT. So they like consuming, they like leisure, LHT. I'm going to define the entire stochastic path of their consumption of those two goods over time and over states as bold XH. And then I'm going to be assuming, just for simplicity, this is not strictly necessary, but for simplicity for today, and I'm going to be emphasizing exactly where I'm going to use it. I'm going to assume that those preferences can be represented by this utility function, which is just a Cobb-Douglas utility function. Yeah. That's going to simplify some of the analysis, but it's not strictly necessary speaking. Okay, good. So they have budget constraints where they like consuming. The price of consumption is PT. They save in risk-free bonds, AHT, which pay the interest rate IT. And then we're going to be including a financial wedge in there, a la Woodford as well. And then we're going to assume that the direct proceeds of this financial wedge on the household age are immediately rebated back with its T tilde. And that's so that the wedge will affect the Euler equation, but it does not change the household budget constraint, okay? So anything that is being soaked up in resources over there is getting rebated back in T tilde so that it doesn't change what the household can afford. Of course, they don't internalize that, which is why delta T is going to show up in the Euler equation, okay? That's important. John.
Clarification, I guess that's the nature of what a demand shock is in this model, so there's no like preference shocks or anything like that.
No preference shocks.
Policy, so demand shocks are delta, is that right?
Exactly. So they're going to work exactly like discount factor shocks would. There's no difference, except that they don't change preferences. So we want to keep the preference relationship stable. Good. Okay, so these households can also save in state contingent bonds. And for the purpose of what we're going to do today, we're going to assume that those state contingent financial assets span the aggregate shocks. Okay, so there's complete markets for aggregate risk, not for idiosyncratic risk. They have income YHT, they have past savings, and they have past state contingent savings. And again, I've described to you this offsetting transfer. And then they have boring constraints, which I'm just keeping as a general description. There's some function of all of their savings that needs to be greater or equal than 0. As I've said, you don't see any taxes anywhere. they're going to show up in one place, which is for the type of counterfactual question that we need to ask. We're going to be allowing for a set of compensatory transfers, TH0, that need to aggregate to zero. So at time zero, there's some fiscal authority that can do rebates across households. We're going to assume that they're lump sum. They only happen at time zero. Why? Because we don't want those transfers to themselves give insurance to households. So that's why they're only happening at time zero. In the paper, we also study a different case, but this is our benchmark. Adrian. You're very correlated.
System of classes that offsets monopolistic distortions in the initial steady state, so that the initial steady state is efficient.
Good. So let me postpone this. We do have those push shocks. They're those push shocks here and here. They're actually modeled as taxes in the objective, and we're going to assume that their steady state value undoes the monopolistic distortion. Yes. To be concrete, you don't strictly necessarily have to put them in, so you could have that as like a permanent cost push shock, and that would work too. Adrian, you had a question.
This is an important, which is a complete market with respect to aggregate risk. So that's kind of rolling out a lot of heterogeneous effects. Basically like perfect consumption insurance for households for any shock. Is that how you think about it?
For aggregate shocks.
For any aggregate shock.
For any aggregate shock, there will be, yes. Not for idiosyncratic shocks.
So then that rules out a lot of. That rules out a role for monetary policy for undoing the redistributive effects of other shocks, because you basically already have insurance against those shocks. That's the part of the market structure. It's okay.
Let me think.
It seems like it's kind of, it'd be interesting to relax that assumption, because sometimes you might think shocks have redistributive effects and monetary policy.
Shocks here will still have.
Able to redistribute can kind of try to undo that.
Yeah, shocks here will still have redistributive effects.
Wow.
Let me show you. Wait. Because of the incidence. Yeah.
Only through this.
Only through the incidence. Yes. Not through the household's choice of like asset holdings. Yeah.
Even the incidence gets some of the effects of that gets undone through the complete markets. They understand.
Yeah.
Not all of it. Not all of it, but yes.
I just want you to keep that in mind.
We can talk about this later, but there is still a large redistributive, and I'm going to show you that this matters, right? So there is.
This is time zero.
The lump sum transfers, yes. Why? Where do you point this at so that it works?
Also, sometimes batteries.
That's okay. So these lump sum transfers only happen at time zero. Now, what the implications of monetary policy are for the redistribution of resources are going to come from this incidence rule that I'm going to describe you now, okay? So as in the standard sticky wage model, we're going to assume that the labor supply is chosen by a union, okay? So let me just write that the amount of leisure time that the household has plus how many hours they work has to be equal to some capital H, okay? I'm going to be needing capital H for a counterfactual question. In the baseline of the model, let's think of age as being 1. Every household is endowed with 1 unit of time, and they can use that for leisure or for hours of work. And then I'm going to assume that they don't have direct control over their hours of work, so that's decided by a union, and that's some incidence function multiplied by aggregate labor supply. So if labor supply goes up by 1%, households are potentially affected differently, as the literature is emphasized as being important. And how does that work? So first, we're gonna bake in some assumptions on that gamma. So if labor stays at their steady state level, we're going to assume that labor supply is individually optimal. That's so that in the steady state there are no distortions to labor supply. But we're going to assume that when employment goes up, relative employment of household age responds according to this gamma age. Okay, so that's the elasticity of relative labor supply with respect to aggregate labor supply. So that object is going to average 0 in the cross section. Of course, it has to average 0. But some households will have a positive gamma age, some households will have a negative gamma age, meaning that when aggregate employment goes up by 1%, some households see their individual employment go up by more than 1%. Some households see their employment going up by less than 1%, and that's what bakes in the heterogeneous incidence of aggregate demand shocks. Yeah.
The details of, how unions work and look at all the unions matters. So these are still a slavery model? People have to work?
Yes.
Okay.
No, you're not going to ask me to defend the union model, please. You know I'm working on alternatives, but I'm just trying to keep it standard, okay? That's the idea.
The first world of monetary policy, it's really about reducing credit risk to an extent, creating jobs, protecting jobs. It's not about hours. So in this version, we did create risk because hours multiply the anyway.
Say again, sorry.
So the way monetary policy, I think they think about protecting people is by creating jobs and protecting jobs, not by changing hours directly. So it's an example, in fact. So the question is, if we have some of this flavor here because you're changing hours which multiply E and so kind of expands the risk, so to speak, shrinks the risk. Because at the end of the day, you care about E, again, E was the endowment. So you care about E times your hours and,
Sorry, what's E?
Oh,
Z. Sorry, you
So
said
Z
the
gets
N multiplies by Z. Yeah, here,
Right.
N multiplies by
So
Z.
that will create some difference that way in a sense. So monetary policy can affect hours, it can affect the effective process you're facing. I mean, that's not.
So I'm gonna show you exactly what monetary policy affects. There will be equations that show you very clearly how this shows up, but there are actually two sources of things. Via affecting these incidents, there's two things. You're going to affect who's supplying what labor, which will show up as distortions on labor supply conditions. And there is going to be a second one, which is who has what income, which is going to show up as an effect on how good risk sharing is in this economy. Both of them are going to be relevant. Both of them are going to be impacted by this incidence rule.
My question to clarify is this kind of similar to make the process for Z depend on monetary policy? It should be over micro-founded more.
I see what you're asking.
Because they multiply, but they're not quite the same thing.
There'll be some differences in terms of exactly how you write the optimal labor supply condition, right? Because if it's Z, something I should have no control over, where if it's labor supply, something I have control over. So the model where Z is endogenous, we have thoughts about it, but we don't have it in the baseline. But there'll be some differences, absolutely. Okay, so then I have to say what I'm doing with profits, okay? And in the baseline, we can extend this as well, but in the baseline, I'm going to assume that profit dividend is just rebated in the same way as the incidence for labor supply, which just allows me to write that aggregate output is the incidence of aggregate output is given by the gamma function, okay? So Z times the gamma function times aggregate output. Good. Okay. So let me tell you about, that's the model, okay? We tried to keep most of the ingredients standard, other than it would be interesting to consider government, which we haven't yet, and one or two other things. But the idea was to write down a model that was general enough that we could speak at the standard ingredients of the Hank literature. And this is really what we're going to change relative to the normative analysis of that literature, okay? It's this efficiency criterion. So the way this is going to work is I'm going to be asking the question of, suppose that at time 0, we reform the way policy is done. When the policy gets reformed, we can send out one-time cash transfers that compensate individuals. That's very much in the spirit of this, of the traditional surplus or Calder-Hicks type analysis. The question I'm going to be asking to measure efficiency is, whenever I do that policy reform and send out the cash transfers, how much can I reduce factor endowments? So in other words, because factor endowments and productivity of factor endowments are 1-to-1 because they just multiply, it's equivalent to asking the question of how much can I reduce factor productivity in this economy while still maintaining some properties, which is that agents are going to be indifferent relative to the status quo location. Okay, so let me describe to you all of the steps that we need to characterize this subject. Yes, of course, Greg.
Before you go into the details of exactly what that means, can you say something about like why? I get that it's a well-defined objective, but why do we want to study this?
Why do we want to study this?
Yeah, like why this objective?
Good. So I actually have thoughts on that in the next slide, but let me just I think this is a very interesting objective in itself, right? It's a well-defined question to measure the efficiency implications of a change to the way we conduct monetary policy. That's how we set up the question, is what should monetary policy do if this is what they're concerned about, right? So it will net out redistributional impacts, which is something that there's the potential for little empirical discipline on. Say, for example, if you set up a social welfare function, which is a standard way of approaching this question, it will embed redistributional concerns in there. And we can have a philosophical debate about how much we care about redistribution or not. Ultimately, there's nothing there's no empirical discipline to how you write a social welfare function. Even the same social welfare function will imply different policies if you renormalize the way you're cardinalizing utility functions, right?
But do you see this as a exercise to help us understand the effects of different ways of conducting monetary policy? Or do you see it as a proposal for how we should conduct monetary policy?
I see this as an exercise of, I wrote down a specific objective, which I will defend, I think is interesting, and I'm going to tell you what the implications of that objective is.
That's kind of boring. Like, let's talk about.
I don't think it's kind of boring. I don't think it's kind of boring. I think it's quite important.
Well, that's what I'm asking you.
No, but
You're just saying, like, put it down, let's look at it. I'm asking, explain why it's important.
no, exactly because of what I just said. Because the standard way this is approached has very little empirical discipline on. And we can have philosophical debates, but I don't think we're going to resolve them.
So the answer to this is my first one. It's a useful way to be able to compare two different policies and then look at what their implications are.
Or what their efficiency implications are, yeah.
So can I ask a follow up on that and say, if you want to abstract a little more with the redistributed concern, there's also just this postulating the dual mandate to begin with, and just say that means to optimal policy versus that mandate. So it looks like this is sort of an intermediate between just saying this is my policy, my objective function, square quadratic of a minimize quadratic between output gap and inflation, and completely microbounded social welfare function. Can you kind of explain why you want to be sort of in that middle, like, or what's wrong with, I guess, the LQ view of things?
Can I put a pin to that? Because we're going to have a lot to say about exactly how this compares to the standard LQ. But just the brief answer is this is answering a very particular question, which is the one I'm describing now. So there's a very clear sense in which I can interpret the units of this, and I can tell you where it's coming from and and in another way, what the LQ, the standard one that you would write as just like quadratic losses of inflation output gap is missing in terms of efficiency losses that are captured here, okay? But another way you can think about it is, to the extent that in some of our exercises we get the LQ to be right, is a micro foundation of that.
That's the foundation of the way.
Yeah.
On the inflation.
But it's not going to be always that, okay? There will be additional things which you would be missing if you were to just write down that objective and work with it.
Opinions might differ to some degree about whether there is any empirical discipline in that deadline welfare analysis, but to the extent that you are taking that as a criticism of the standard analysis, there is no such thing in the real world, no empirical thing that you can measure corresponding to your the sort of transfer. So saying that the other model doesn't have any empirical discipline when your model builds in these fantastical transfers that never happen in the real world.
So let me be clear, the transfers are about an hypothetical question, okay? The answer to that question, I can implement it empirically.
I know, but I mean, what is
The transfers don't actually have
what is the relevance of your answer? Transfers could never see what
exactly what I'm going to tell you. Can I go through it? And I think I'll answer these questions, okay? Okay, good. So let me just tell you how this is exactly computed. We've already done a lot about what it means even before we actually know what it is, okay? So how is it computed? So I'm going to have some status quo with some status quo policy. So the DGP will generate a status quo allocation. Let me denote that by X naught, okay? That's done under some baseline policy. I am going to be considering a new policy, P, okay? And when I consider the new policy, I'm going to be asking, what is the set of equilibria that can happen under that new policy, okay? When I do that, the way I'm going to span the set of equilibria is using those lump sum transfers at time zero, okay? So again, only at time zero because we don't want those transfers to themselves provide insurance, so we don't get rid of the interesting parts of the model. You'll see at the set, this is a set, okay? There are many equilibria that are in that set. They're indexed by this age parameter, which controls how many hours in total the household has. And the way we're going to do this is we're going to ask how much can we shrink age such that how much can we contract factor productivity? How much can we shrink that age such that all households are at least as well off as they were in the status quo allocation? Okay, so let me define that object mathematically. Mathematically, I'm going to be asking that for aggregate productivity is going to be the maximum age. Why the maximum? Because now you see I'm putting 1 over age, so that's a little bit of a trickery there. So I'm going to be contracting productivity by taking 1 over age, shrinking factor endowments, and I want to ask, as I shrink that, are there still equilibria in that new set that is generated under the new policy such that every individual is at least as well off as they were in the original allocation? Okay? Notice that there I'm just using the preference relationship. So by construction, if you were to feed in the status quo policy, that will just spit out a 1. The status quo is as productive as itself. What does it mean to do a policy and come up with a 1.1? That means that under the new policy, there are equilibria such that there's at least one equilibrium such that I could throw away 10% of resources and still make every individual as happy as they were in the status quo allocation. Okay, that's what it means. So that means that there are potential Pareto improvements, right? Because at the end of the day, I'm not going to be throwing out those resources. So in the actual economy, there are Pareto improvements over the original allocation.
Just to clarify that you feel with, that requires particular patterns of these T's.
Yes. Yes. Doing a Pareto improvement will require particular patterns of these T's.
And there is heterogeneity in the initial.
And basically that will say, yes. And basically that will say that these 10% of surplus that you've created, you have to redistribute them somehow, right? And so the Pareto improvements are the ones where you take this and you make sure that everyone gets a little bit of that surplus, okay? That's the points that are Pareto improvements over the original one are. Good. Okay. The important thing to notice is that this definition really only uses the preference relationships. There's nothing about utility function that is used there. So it's going to be invariant to how you write utility functions, going to be invariant to how you cardinalize utility functions. So it's really very different from the way we would write standard social welfare functions.
Just a clarification question, and I think I made just missed that on the previous slide. So what exactly is age? So what's the factor of endowment? So is it just...
It's total time. So the only factor in this economy is time. Everyone has one unit of time, and they can use that between leisure time or work. Okay. And then, yeah.
And now, so what if you had another factor of production, like capital?
You would do, so the baseline way of doing this would be to do factor productivity of all factors. So that would be
down, like...
Sorry?
You scale the factors down proportionally.
All of them. That would be the baseline. Now, in this companion paper that we have, we actually show that for the purposes of what I'm going to show you, which is the LQ approach to solving this, the way exactly you choose, which factors you choose to scale will just show up as a constant, as multiplying everything. So it will not affect the optimal policy that you choose. But globally, it could matter. Okay? But yeah, but the way you would do it, just in the baseline, would be scale all factor endowments, including capital and all the labor factors.
Why is it factor? So what if I have just an endowment that's not a factor of production? Would I also scale that down or not?
What do you mean, just an endowment of the good?
Yeah.
That's a factor with a very simple production function.
Okay.
Yeah, the language is general, right? Yeah. Does that make sense?
Yeah.
Okay, cool. So our objective function is going to be maximize aggregate productivity by choosing the policy P, okay? So as I said, the objective here is to look for maximizing aggregate productivity or aggregate surplus. And the way to think about it is, as I do the new policy, I will not shrink factor endowments anymore, right? As I do the new policy, I'll actually keep all the factor endowments. But what the hypothetical exercise is going to say is, I actually have surplus in the new economy that allows me to generate Pareto improvements. Whether you actually move to those Pareto improvements or which Pareto improvements you move to will depend on exactly how you design those transfers. And that's something that the theory takes no stance on. So that's the sense in which it nets out redistributive concerns. Great.
I don't want to push back on that a little bit. It's not, there was an if there as well, not just how. It's like if you generate a rate of improvement, it all depends on what those transfers look like. And so you go to a central bank, you say to them, there's a different P, conduct monetary policy in a different way. I mean, it doesn't tell them anything about what the outcomes are going to be for households because it all depends on what the fiscal policy does in the background over here.
The possibility of generating Pareto improvements will depend on the availability of the transfers. Yes.
But then once we have those transfers,
Yes.
there's a whole bunch
So there
of
are
policies
multiple.
outside of that one that also have the ability of generating.
There are multiple. Let me say.
As in all of the complete markets. So I'm not sure what inspires you on top of just if you have transfers, you can do better.
So there are multiple ways of thinking about this. You can think about it as there's an hypothetical question, which is just trying to measure efficiency, netting out who's going to get what ultimately. There's a well-defined, well-posed question, whether it should or should not be the objective of the central bank. We can have discussions over beer later today. There's a well-posed question. Then there's another way of thinking about it, which is suppose you do this exercise and you find huge productivity gains, right? Even if you don't think that those transfers are actually happening right now, that could be a signal that you may actually want to think about it as like a serious policy, exercise that could be or should be implemented. But we're not taking a stance on that, okay? So I want to say there's a well-posed question, which is measuring a very well-defined criterion, which is efficiency. And I'm going to ask, suppose that a central bank only cares about that. Here's what the central bank should do. That's all I want to say. Me, yeah.
You can say something like our taxes are paid in this model, but it's like proportional taxes, that would not really.
There are no taxes, so I don't have a government. That's something we haven't baked in yet. That's in the to-do list. That's in the to-do list, but there's no transfers, but we haven't put in the government. There's no distortionary taxes. And the reason not to have it is that those will be extra additional sources of inefficiencies, right? Because those taxes will themselves be distortionary. So I want to show you what the monetary side of the model is doing before we put in other things. So it's just to keep the analysis as clean as possible. That's the idea. It will be distortionary. I'll have to care about how that works. And we haven't put it in just to show you what the monetary side is doing. That's the idea. Okay. So let me show you how this would look like in the representative agent model. So representative agent model is quite simple. Yeah, Javier. Can you say louder or turn on the microphone?
Just to clarify, does the initial T that is undoing the distribution depend on the normalization of the welfare of agents?
What do you mean by the utility function? No, just depends on preferences. Just depends on preferences, not how I characterize those preferences as a utility function. So preferences can be represented by infinitely many utility functions, right? And it just depends on comparisons. Does it not depend on the levels? Yeah, that's quite important. Thanks. Good. Okay, so the rank model is actually quite simple. There's no heterogeneity, there's complete markets. So everything gets really simple because now I cannot do any transfers. That's kind of trivial. If there's only one person, there's no compensations that I can do across people. So then that script X, the set of new equilibria under new policy is a singleton. And so here's where I use what I've written for preferences, because I've assumed that the preferences are homothetic. Now I'm really going to use it because it becomes simple, is as I'm changing factor productivities with homothetic preferences, it's just going to scale up and down all consumptions of leisure and consumption, okay? So then XHP is whatever is the equilibrium under the new policy P multiplied by age. The smaller is age, the less the agents are consuming of everything, but everything scales proportionally. Okay? That's really where I'm using homotheticity. Because I just want to show you like what the objective looks like. So now I'm looking for the maximum age such that the implied path of consumption and leisure, where I now notice I'm multiplying by age minus 1. That's why I'm doing the contraction, right? I'm maximizing age minus 1, contracting those things, such that the new equilibrium the agent is at least as well off under that new thing relative to the old one. So this is kind of simple now, right? This is just preferences, but if I know that preferences can be represented by utility functions, then I get to just change by the utility function. Then we know that the utility function is decreasing in that age, so that inequality becomes an equality. But then that's just an equation to one unknown, which is age. So really you can just take the age. What did I do? You can really just take the age. It really hates me. So you really can just take the age, put the AP inside, okay, right? So now that's the maximum one, is the one that sets this inequality. And the maximum age is the one that contracts the consumption such that the agent is indifferent relative to the status quo. Now let me use the log utility function, and then I can just write that log aggregate productivity is just the difference between the utility of the agent under the new policy minus the status quo, okay? That's where we're using homotheticity a lot. And I just want to show you that, like, in the representative agent model, it really just becomes the Lucas measure, right? The Lucas consumption efficiency measure, which is somewhat reassuring. And it also means that if you were to maximize aggregate productivity, really what you're maximizing is the utility under the new policy in this case. So really, the optimal policy will just coincide to what you would do in the standard Ramsey problem in a representative agent model, okay? Ben?
Just to understand, the fact that it's the Lucas measure, does that rely on log utility or not?
It relies on homotheticity.
Okay.
Yeah. The fact that it's like the difference depends on log, otherwise you'll get the ratios to the power of some function of the sigma. Yeah. Okay, good. So as I told you, our analytical analysis is going to be based on the linear quadratic approach. And one thing that I want to show you is how this works, because we have this AP problem, okay? In a representative agent case, it's really simple to characterize, but generally it'd be really complicated objects, okay? So we actually show in this other paper that we can do a lot of progress by just considering the linear quadratic approximation of that aggregate productivity. Meaning that we're going to take a second order approximation of that AP. Okay? That turns out to be true in a very general in very general settings. So this other paper actually does completely general heterogeneous Asian economies. And the key result is that the policy can be approximated by minimizing the sum of deadweight loss triangles, a la Harberger. Okay? And we exactly show that these deadweight loss triangles can be characterized by just observables. And the observables are expenditure shares, micro price elasticities, and the elasticity of wedges with respect to policy, okay? So those are the three things you need to know, and then you can implement all of this, okay? So it doesn't really use anything that is non-observed, say like Pareto weights are not used anywhere. And so it's really just based on things that you could actually measure in the data, okay? And we've discussed a lot the lump sum transfer. So in the Hank paper, we're keeping just lump sum transfer at time zero. In this paper, we actually show that everything can be extended to what if those transfers need to be done in a distortionary way. I don't have a lot of things to say about it today, but in the paper, we have some applications like the fiscal unions and so on, where we actually emphasize how these distortions could also change optimal policy, okay? Not for what I'm showing today. And this goes back to what we were discussing with Greg, where the way you can do these compensations will matter for what Pareto improvements you can implement. In general, there will still be something you can do, even if the transfers are not fully lump sum.
So if I ask Adrian a question again to an extent, so it seems like now we're going for linear quadratic in the sense we've kind of gone back to dual mandate kinds of things. Is the content here the fact that now we can say what the dual mandate's about? So it's not just about unemployment and inflation, but it's about some approximation of the A function. Is that the nature of this, or is it what do we gain relative to starting with dual mandate?
Can I show you exactly? Because that's exactly where we're gonna go. Like I'm gonna show you exactly in which cases you get the standard dual mandate, in which cases you don't. Yeah, that's the whole philosophy. Chris.
On the observability point, just very briefly elaborate a bit on what those wedges are, what the elasticity with respect to policy is.
Can I show you in the next slide?
Oh, okay, perfect. Yeah.
Good. Okay, so here's what you need to know. So basically, take any model with incomplete markets, externalities, markups, so on. In general, that type of model can be implemented as an Arrow-Debreu economy if you choose appropriate wedges in optimization, okay? Those wedges are going to account for all of those market failures. So you write down the Arrow-Debreu economy with those wedges, and then we show that to second order in the wedges, aggregate productivity takes this form. So aggregate productivity is going to be, so the amount of status quo misallocation, which is something that is not affected by policy. It's just a measure of how distorted your original equilibrium is. And then from that, you subtract the deadweight loss Harberger triangles, okay, which are just what are the wedges that you have to include in the economy to match the allocation you started with in the original economy, how much it's distorting consumption of every good G. So this is completely general. This is for any economy with certain good Gs. And then you have to weigh each one of those Harberger divided by 2, because the area of a triangle divides by 2. And then you multiply that by the expenditure share or the sales of the market G. Okay, so every Harberger triangle is weighted by how relevant that market is for total GDP. Okay. So the things you need to know here, as I said, are the expenditure shares. Those are things that you can just take from the data. You need to know the elasticities of consumption, which are going to enter into the chain, into how wedges affect G. And then the wedges themselves. Okay, so the final thing that you need to know is how are the wedges affected by the policy? You can plug everything in there, and then you can maximize this with respect to the policy. Okay, so that's the idea. In the rank model, and I need to speed up a little bit. In the rank model, you see that this is just going to take the standard formula that you would find in the Woodford tech or the Galil textbooks, where you just want to minimize output gaps, inflation, and wage inflation, because here we have both sources of nominal rigidity. Okay. So next I want to show you how this looks like in the Hank model, which is going to be more complicated. So this is going to answer John's question, not just John's, but everyone's questions, okay? So how does that work? So first, I need to identify the wedges. So how am I going to identify the wedges? So I'll have price markup wedges, right? Because of sticky prices. This is really not wanting to cooperate. So because of sticky prices, firms are not pricing because of sticky price and monopolistic distortions. Firms are not pricing according to marginal cost. So I need to measure those wedges. Unions are not setting their own individual wage equal to the average wage. So I need to put in a wedge in there too. Workers are not necessarily on their labor supply. So I need to measure the wedge in there. And then I need to measure the incomplete market wedges, which are telling me how much agents are able to smooth consumption over time. Okay. So those are the 4 sets of wedges that you need in this particular economy. Doing that, you can construct the Arrow-Debreu economy. So this is an economy without any frictions other than the wedges. So you need to construct the budget constraints, which take standard Arrow-Debreu prices, but then multiply them by the wedges, and you need the wedges on the labor supply, and then there's the households have some income, and there's wedges to firm optimization as well. Using that, you can construct the deadweight loss approximation, where you have all of the Harberger triangles, which come from each source of inefficiency in the model. And let me just show you what it looks like in the full model. So first, you get the standard rank ones, okay? That's natural. Of course, you're always going to get the rank ones. What do we get additionally? One set of additional wedges comes from the dispersion of the incidence rule, right? So because there's different incidence of aggregate demand fluctuations, when we vary output gaps, that's going to open up dispersion in labor wedges, and I need to account for that. So that's going to be proportional to the incidence rule. And then finally, I have the incomplete market wedges and the way they relate to how monetary policy can change who has what income, which again has to do with those gamma ages. Okay. If you maximize this, then you get a first order approximation of optimal policy around the efficient equilibrium, means that no shocks, no aggregate, no idiosyncratic shocks, and 0 inflation. Okay. So here's the thing again. I first want to study what if we have homogeneous incidence, meaning what if the variance and the covariance are 0? Then you have this objective where you see it's just what you'd get in rank, so the standard dual mandate plus something that has to do with the incomplete market wedges. Okay, so this is not exactly the same as just assuming that objective function to start with. There's something else, but the result is, in that case, the incomplete market wedges turn out to be orthogonal to policy. So even though the objective itself accounts for these extra wedges, which are there and are efficiency losses, there's nothing that monetary policy can do about it. So the policy just becomes the minimizing the standard losses. Okay. When you have heterogeneous incidence, now two things show up. One is the variance in incidence creates heterogeneous labor wedges, but it will also able to do insurance. And so with just sticky wages, we can characterize everything simply because we can derive the targeting criterion. And there are two deviations relative to what you would find in the textbook. So first, you see that the weight that is put on output stabilization is higher, and is higher, you see down here, it's higher exactly because of the variance of that incidence rule, okay? So because it opens up dispersion in individual labor wedges, output fluctuations deteriorate more aggregate productivity relative to the representative agent model. The second one is the fact that you get to provide insurance, okay? But our main result is that in the limit, that part about providing insurance vanishes, that in the very long run, there's really nothing the monetary policy can do to provide insurance. So then really what survives is just the higher weight on output stabilization. You can do that result in full generality with both sticky wages and sticky prices. The same result is true. Optimal policy will generally be a deterministic path that just accounts for those insurance gains, and then a part which is just like minimizing 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 a standard dual mandate with higher weight on output stabilization.
We used a lot of your.
Thanks. Good. So let me actually, I can show you, we have a calibration where we calibrated to the Gouvenon numbers for gamma H, and we attribute all of the Gouvenon numbers to that incidence rule, which again, as we discussed with Giuseppe, maybe part of it is coming actually from productivity. So think of this as an extreme calibration where everything is being attributed to labor supply. Okay. We find here that the deterministic thing is very short-lived and not huge, but instead, because of the heterogeneity in incidence, the variance of the gamma ages, you have a strong incentive for output stabilization relative to inflation stabilization, and you get the cumulative output gap in response to a cost push shock is 10.7% closer 10.7% closed relative to the rank model. Okay. Okay, so just conclusions. The idea was to think about a central bank with an efficiency mandate. We derive these implications. We show that really the big things are whether there's homogeneous or heterogeneous incidence. Quantitatively, heterogeneity in incidence can matter. And the broader message is that here the idea was to develop a general theory of second best, to think about policy design in a world where you want to think about the policymaker as using a cost-benefit analysis and not really thinking about who's going to get the ultimately what resources, okay? So then you don't have to think about cardinalizing utilities, social welfare functions, none of that stuff comes in. And this is actually pretty broadly applicable. We have a lot of other examples, okay? Thanks so much.
Should be forward. Okay, we're ready to start back up. I was just noticing, this is my 31st year, I think I've been here. I think in 1996, Chris had me on the program as a graduate student from Michigan. And so I think I've been here every year, except one. And so now we have somebody doing their first presentation here, and maybe 30 years from now, you'll continue. We have Ekaterina talking about human capital accumulation and the long-term effects of temporary sectoral shocks.
I beat you by 6 years.
Yeah, like, in many things you do, Chris.
Thank you. Thank you very much to the authors, to the organizers for having this paper in the program. So I'm very excited. This is my job market paper, and I just finished my PhD at UCLA this year. So let me start with a motivation. There's a very large literature studying how sector level shocks propagate through the economy, and dating back to 1980s, continuing with more recent studies, they investigate different channels through which it happens, like production networks or demand complementarities. The question that I'm going to be after here today is whether human capital accumulation can also be the mechanism through which the adjustment happens once we have sectoral shocks. And I'm going to focus on temporary shocks. The reason why I'm starting to talk about human capital accumulation is because when we have such a shock, let's say a demand shock to a specific sector, it's going to affect the individual choices that the workers are making over their life cycle. And the two margins that I'm going to be focusing on here are the educational attainment. If we have a shock in a particular sector that employs a lot of unskilled workers, it's going to affect the skill premium in the economy and change the incentives to acquire higher education. The second margin being affected is sectoral allocation. By changing the relative demand for specific sectors, the shocks can affect where workers go to work in. And we know from a large applied literature that even temporary shocks can have permanent effects on the individual worker trajectory. The question that I will be asking is whether they can also generate persistent aggregate effects in the economy. So this is what this paper is about. It studies the role of this, the channel, the human capital accumulation, in generating persistent effects from temporary sectoral shocks. The way I'm going to address this question is by proposing a quantitative life cycle model which incorporates endogenous human accumulation specifically through those two margins that I've just mentioned. So let me walk you through the main mechanisms that I will be describing throughout this talk. If the economy is hit by a temporary sectoral demand shock, it's going to affect first the incentives to acquire education. I will only focus on higher education here. And there is one fact pretty well established in empirical literature that I want to highlight, which is if the workers forego college when they're young, it's getting harder and harder to go back to school as you become older. And so this is why the timing of this temporary shock is really important, because now different cohorts are going to be differentially affected by the shock. So the second margin that's going to move is sectoral allocation. And here, again, there's a fact that a lot of papers emphasized, which is while you start working in a specific sector, you accumulate some human capital, which can be imperfectly transferable. If you decide to switch to a different job, you might potentially lose some of your skills, or you cannot transfer them and apply them on a new job. So where you come to work early on in your lifetime turns out to be important, as it's creating the opportunity cost of moving later on. So now this is more of a partial equilibrium view of what happens when the shock hits the economy, how this is all leading to the aggregate and persistent effects that I've mentioned before. It's happening through the general equilibrium. In particular, considering the overlapping generations is important here, because at the time when the shock happens, the current cohorts are making decisions. They are not necessarily internalizing the future generations that are yet to come and can have spillovers on those generations later on along the transition. So I will be proposing this model and describing it in a lot of detail, but I will also talk about specific case study here today, which is the Spanish economic boom that happened in the late 1990s, early 2000s. I will give you more details as well about this case study, but basically what it was It was a huge boom in the construction and housing sector that followed the European interest rate convergence and translated into increasing demand for unskilled young workers that construction sector employs a lot. So what I'm going to show here today is that the shock also had persistent, it resulted in a persistent decline of educational attainment by young workers. And I'm going to use this case, I'm going to use this episode to calibrate the model and speak to sort of quantification of how important this channel is for explaining some of the productivity dynamics in Spain. Okay, so this is what the paper is going to feature, and now I'm going to give you a brief preview of the results. So the temporary shock to a low-skill sector, which construction is, I find that results in a pretty long transition to the long-run equilibrium, which can take from 50 years, but in some calibrations, extensions, even more than 50 years. It's also going to connect with the persistent decline in productivity throughout this transition, with an average loss about 0.8%. And what I want to emphasize is that it's largely driven by the changes in within sector productivity. So this is something that we also see in the data, if we look at this period in Spain, is that it's not just about the story is not just about reallocation of workers towards less productive sector. It is actually something about changing the sector level productivity as well along the way. And this is where human capital accumulation mechanism is going to be very important at explaining that feature of data. So finally, I also look at the distributional effects, and I focus on the changes in lifetime earnings of different cohorts as a result of this shock. I find that the distributional effects are quite large. Some of the cohorts are benefiting from the boom. Some of them turn out to be negatively affected, and I'm going to also describe why that is. So this is the benchmark set of results. I also conduct some counterfactuals to study how important are different economic forces behind this mechanism, like what is the importance of the spillovers, or how important it is to have this imperfect transferability of human capital in the model to explain the aggregate dynamics. So if I have some time, then I will briefly comment on that in the end. Okay, so in terms of literature, there are many papers that study different aspects of either sectoral shocks or human capital accumulation. Of course, there are a lot of papers and a lot of empirical papers that talk about how sectoral shocks affect human capital accumulation. So I'm going to focus really today on providing the solution for the general equilibrium and the transition of the economy after the temporary shock. Then there is also a large literature studying how imperfect transferability of human capital and skill specificity matters for the transitions. So since I'm talking the temporary shocks here, I think I will show you that it's really important to combine both margins of educational attainment and sectoral allocation when we study over the life cycle, when we study the effects of the shocks. Finally, there are many papers that talk about the boom-bust cycles and aggregate productivity dynamics, and there are papers that actually study Spain in the same time period as I do. So compared to those papers, I will talk about slightly different channels. So I would say that I view my papers complementary to them, and I will focus on the cross-sector dynamics and obviously focus on the labor market. Okay, so this is the outline for today. I will start with some empirical evidence just to convince you that when this construction shock happens, the education margin is actually going to be affected, as well as the sectoral reallocation of workers. And I'm going to spend most of the time on the model and talking about the quantitative analysis. So a few key facts about the Spanish.
Question.
Yeah, please.
Just send
Mm-hmm.
a picture about sort of, human capital as an amplifier of these sectoral shocks. So I can see the story obviously in this construction boom case, but I mean, to what extent does it apply to other sectoral shocks, right? I guess you really need the sectoral shock to be sort of either very skill biased or very unskilled biased somehow for this story to kick in. Is that right? So what if it's I don't know, like some sort of normal sector that's sort of not as special in terms of the skill composition as construction?
Yeah, thank you very much. I think that, first, the skill composition matters for this analysis. So there is a different dynamics if the shock happens to the skill biased sector, and it's not symmetric to what we see here. I would say that probably if if it is a shock to the sector that is not in particular biased towards unskilled and skilled workers, we still do have a little bit of a trade-off between there is a force that draws people into the labor force, and there's incentive to forego education just because the opportunity cost of education becomes lower. But then the question would be, is it a very large shock or not, and how that affects the overall supply of skills, whether it increases or decreases depending on sort of what the sector is. I would say that those margins are still going to move, and they're going to move a lot if there is a clear bias towards a particular skill in the sector. Then the two forces become very large, and they sort of we can think about whether they offset each other or not, or act in the same direction. But yeah, thank you. Okay, so moving to the Spanish boom, it started, as I mentioned, following the European interest rate convergence, and it was largely consumption-driven boom. The real GDP was growing a lot during this time, as well as the labor force participation and hours worked. Yet the labor productivity really slowed down at this time, and it was very different compared to any other European countries at the moment. So just to give you, just as a motivation, let me show you this picture, which plots the most naive measure of labor productivity that I could come up with, which is real GDP per hour worked, PPP adjusted. So here we have Spain in orange or red. And then we have core Europe, Southern Europe, and basically Northern Europe. That's the blue line. The shaded region is going to be the boom. Throughout the talk, I'm going to use this to highlight the period I'm focusing on. So you can see that prior to 1995, the productivity growth looked very similar across different groups of European countries. And then starting in the late 1990s, Spain was really an outlier in terms of this labor productivity growth. And even compared to other Southern European countries, which also run current account deficits, also experienced the same decline in the interest rates, the thing that was really different about Spain during this time was the housing boom, the construction boom. So I'm going to be focusing only on the period of the boom, not going to speak to what happened after the recession. And I'm going to try to think about how much the human capital accumulation margin can sort of close this gap. So as I mentioned, Spain had the large construction boom, and it was mostly concentrated in residential construction. The housing prices more than doubled by 2007, and it really translated it into the real construction. So it was not just the housing bubble and increase in prices. We also see a lot of new construction sites, and the employment in the construction sector increased a lot during this time. So what I'm going to show you in this paper is that in the same time, the young workers reduced their educational attainment, in particular did not went to college, and instead they joined the labor force and they went to work in this construction sector. Yeah.
Why do you want to include the finance industry with the construction industry? Like, plus fire, I know there's real estate in there too, but.
Oh, sorry, it's financial insurance, real estate. So if you want to think about the broad sort of what are the jobs that come out of the housing boom, this would be it. I mainly use this as a benchmark to the other paper that studies by Charles Hurst and Nathalie Digdo that studies the housing boom in the US, and they provide a similar figure.
These two sectors could have very different skill mixes, right? So
yes, absolutely.
Skill and fire would be relatively high skill.
If you think about the male workers, the construction is going to be like over 90% of this total employment. So fire is this much smaller sector. Thanks. It is true. Yeah. So it's going to be mostly the skilled, the educated female workers that go to those services. Yeah. Thank you. Okay. So what happened to education, right? Here, I'm showing you enrollment rates for 16 to 20 years old in Spain. 16 years old is when the mandatory schooling in Spain concludes. So then everyone decides whether they are going to prepare for college admissions or not. So that's why I'm focusing on this age group. I have male and female population. And you can see that starting from the late 1990s, enrollment drops. For male workers, it drops by almost 50%. At the time. And I can assure you that there were no significant reforms that would explain this decline. So a lot of that is really driven by the boom. And I do a formal regression analysis with the instrumental variables to show that the construction boom is what accounted a lot in this decline in educational attainment. So you can see that it drops, it stays pretty low up until the bust happens, and then it starts, sort of slowly going back up on trend. One thing that I want to comment here on, you might ask me what happens to female workers, why there's also a decline in education for them, because they don't obviously go to work in construction as manual workers. What I'm going to show you in 2 slides is that female workers, they do go to work in the low skill services, which is sort of another non-tradable industry that is booming next to construction. But I will really think about the construction, the housing sector as the source, the main source of the shock here. Okay, so fact number 1, there is a decline in enrollment. So immediately when the shock happens, the workers drop out or do not go to college and they join the labor force. So what happens after the bust happens? Because the boom lasts for about 10 years. A lot of those people are still going to be in their mid-20s or early 30s by the time the bust happens. So here I look at the completion rates by different birth years. So each year is going to be a different cohort. And the shaded region is what I call the affected cohorts. Those are people who were 16 to 20 years old at the time of the boom. So now I'm going to track them further in time, and I'm going to see if they eventually graduated with a high education degree or not. What we see here is that prior to those affected cohorts, there is an increasing trend in educational attainment, something that you probably would expect, a bit of a steeper slope for female population as well. And then for those affected cohorts, there is really a bit of a decline in the completion rates as well. So that tells me that even many years after the bust, they never returned to get the college degree.
You mentioned you do AB. If I look at this picture,
Yeah.
I see a clear trend. Of women going to college more than men, not just the one you just put.
For the completion rates, I don't do the regression analysis. I'm just looking at it. The pre-trend, oh, you mean like it starts?
It's for everywhere. Women are going
Yeah.
to college. What is your
Do,
question?
yeah,
So what's the, why are you saying,
It's flat.
seem to be saying that this is persists because of the crisis?
perceive.
Or not the conclusion of this? Or anything?
The conclusion that I want to make here is that prior to those affected cohorts, there is an increasing trend. Then for whatever reason, there is a stagnation and a bit of a decline even for the male workers. And even if you think that, oh, maybe it's just converging to some flat area, I'm going to say that, well, but after those cohorts, it goes back up on trend. So this is the, yeah.
Women. Yeah.
I mean, I'm going to talk a little bit about women. The model is not going to be about men versus women, but for the empirical evidence, it's sort of impossible to just look at the average rates without understanding what happens separately for men and women in the labor market.
Really quickly. Any catch up at all? So here you're doing the completion like much later, but you could do this math kind of during the boom and then see, is it true that if you forego education, there's some catch-up effect where later you go back, or is it that there's actually not? So meaning it's you decide to go to college at age 18, and then perhaps you forego college for 6 or 7 years and then you go back, or none of that at all.
That's a good point, because, well, I should probably say that in Spain, I've heard recently that it's very easy to enter college and then take like several gap years, and basically it's almost impossible for the university to expel you from college. You can go back later on. If I plot this graph for slightly different age cutoffs, it's going to look very similar to this. I'm choosing this 25 to 34 years old primarily because of the sort of what the data looks like, how much data I have for each cohort. But yeah, that's it's going to look similar. You're still going to see similar effect. Thanks. Okay, so this is what I've shown you so far is that there is a decline in enrollment at the time of the boom, and we do not see these people coming back and getting their education after the bust happens. So finally, the last picture that I'm going to show you today is what happens to their employment. There's also an increase in the labor force participation, which is not here, but I have a button for this, but conditional on now being in the labor force and not in college, which are the sectors that those people go to work in. So as I mentioned, for a female, yeah, I'm going to comment a little bit there. On the right panel, you do see that there is one sector that employs the majority of those 16 to 20 years old female workers. That's low skill services. A big chunk of that is wholesale sector, a wholesale trade. So this sector also sees an increase in employment for young female workers. For male workers on the left, there are 3 sectors. There is also low skill services. There is manufacturing in blue, and there is construction in red. And you do see that low skill services is still the largest sector. It's somewhat flat during this period. For manufacturing, there is a bit of an increase, but if anything, it starts going down in the second half of the boom period. And then you see construction, which spikes from 10% up to almost 25% employment for those young male workers.
The construction and fire here?
No, this is just construction.
So the blue line for women would be things like the real estate agents.
Basically, it's not here, so it's basically zero here.
Oh.
It's like 2% or something. That's the line. Yeah. Thanks. Okay. So that's all I will show you in terms of the empirical evidence. Yeah, question.
Just curious, your first fact about output over hours, one could just interpret that as a compositional effect, right? In the sense that these people that weren't going to be in the labor force are now in the labor force. Do you want, like, I'm just thinking about how you want us to think about that interpretation moving into the model.
Yeah, so I will say that in terms of composition, if we think about the sort of just the business cycle dynamics, there is obviously that they mentioned where, yeah, there is an increase in production and employment, and people of all ages to some extent increase their the labor force participation. This is a very big shock. So we do see that the young people increase labor force participation much more. And I will say that one of the reasons why this happens is because there is a very big bias towards unskilled workers in construction. So it can actually absorb all of those, it can hire all of those young workers that do not have to first get their education done. If I decompose, now the separate thing is that if I decompose that productivity into the reallocation effects, like keeping sector level productivity and just changing sort of the shares of the different sectors, we do see that the reallocation does not contribute much to this effect. The most of it is coming from the sector level change in the productivity. And in the paper, there is a variance decomposition exercise to think about that. Thank you.
I think the point was just that you draw in a whole bunch of
Yeah.
very low skilled people, and of course, productivity is lower when you have a whole bunch more unskilled, low skill, low productivity people. Right.
Yeah, and that's exactly, thank you. Okay, thanks. I guess maybe I misinterpreted your question. And that's exactly the point of this, right? So I want to say that that there is a difference in people of different ages in terms of how experienced they are. And when we think about whether you also need education or not to enter a specific sector, there is a time period that you have to spend outside of labor force in order to get this education. Shocks like that create an opportunity where you can join the labor force earlier and you're less experienced. So that's exactly what is accounting for the change in the sector level productivity. Yes, thank you.
You said two words about the institutional context,
Mhm.
because I mean, there have been like major labor market reforms in Spain, you know, the dismissal costs have been reduced and it's generated sort of more dual labor market. But that happened
Yeah.
after the financial crisis, I guess,
Um,
mostly.
mhm.
Is it?
I mean, yeah, so the
Timing right, so that doesn't apply to your exercise, is that?
yeah, thank you. Thank you very much. So yeah, Spanish labor market features the dual contract system where there is a very large share of temporary contracts, and they do and mostly the young workers are the ones that get those temporary contracts as opposed to the older workers being hired by permanent ones. So this does create the environment in which it is very easy to hire but then fire a bunch of people. So what we see in terms of decline in employment afterwards, we can think of this as there are no additional frictions to firing all of those workers. That's why after the bust we see a decline. There were some reforms that happened through like in the middle of the 2000s, so it was prior to the bust.
Okay, no, because I was thinking, you know, whether this, you know, sort of the contracts you're hired on may affect your incentive to accumulate human capital.
Okay, yeah.
So, short-term contract.
Mhm. Perfect. I'm not going to really speak to the micro foundation of how you accumulate human capital here while being on a job. So I guess the stance that I'm taking here is that there is something almost mechanical about being in the same sector, becoming more experienced at it. So it's not the endogenous effort that you put into that, like time or, for example, or your resources. Yeah, this is basically, yeah.
And just to,
Mhm.
in your favor, there's also like regional variation that you're using where those national things are netted out, in the places that had the bigger consumption booms are actually the ones that had the lower decline in results.
Thanks.
And just-
Yeah, in terms of the empirical evidence, yeah,
Empirical.
that's true. Yeah, for the model, I'm not gonna hardwire the endogenous effort to accumulate human capital.
Asking my question from the beginning again slightly differently.
Mhm.
Yes, what are other sectoral shocks that would have these large effects through human capital accumulation? As in, is this a paper about the Spanish construction boom of the late 90s? Or is it something more general? Like the title of the paper is Human Capital Accumulation
Yeah.
and Long-Term Effects of Temporary Sectoral Shocks, which suggests that you think it's sort of a more general story. I guess I'm just wondering, what are other
Yeah.
shocks where this would be at play?
A very large literature that this is related to is the Dutch disease literature. There are a lot of papers that also empirical papers, mainly that show that the Dutch disease episodes, that the oil boom episodes, for example, they do result in decline in educational attainment and this lock-in mechanism in the sector, which is first unskilled and mainly, but also has a lot of sector-specific human capital, which is not easy to transfer out of it. So that would be one example. I think that it has the potential to think about the tradable, non-tradable composition of different sectors. I wouldn't necessarily say that this would be perfectly applied to shocks like AI or something, because I'm not thinking about the growth here. It's sort of more of a short-term deviation from the steady state and going back to it.
So that's kind of exactly related to my question. I was describing this as human capital Dutch disease. And so my question was, do you see other elements of other types of capital that reallocation like we see typical Dutch disease here, or is it just in the human capital?
That's not something that I was looking at, but I guess, yeah, that's there are a lot of things that are special about construction in terms of like physical capital investment and
Like
this being, no, absolutely. Absolutely. This is something that I'm completely abstracting from in this analysis, but for sure, in terms of having a large quantitative model, it's a very important part of it, thinking about how it also affects the capital accumulation.
So, to the extent that we think that you are finding powerful evidence for a general mechanism of human capital accumulation having permanent effects, the ideas here could easily translate into business things, right? If the reason GDP recovery is often slow after business cycles is that there's been a lot of destruction of human capital, but you take her estimates, you transfer them to a business cycle model, and you get much more persistent.
Thank you. Thanks.
Go to the model.
Okay. Thank you very much for all the comments. This is very useful. So let me give you a brief overview of the model. It's going to be an overlapping generations model with the finite life cycle. So this is going to be a very important component to think about the cohort-specific allocation. And the workers will be able to choose to acquire education or not. They can do so at any age. There is no restriction on the timing. And what this choice does, it determines which factor of production you are. So everyone is born unskilled. If they decide to get education, they become skilled. The two inputs are going to be complements in the production. And importantly, education is a time investment. So I really want to be thinking about the opportunity cost of education here in the model. In order to become skilled, you'll have to spend several years outside of the labor force. Now, in each period, on top of that, the workers will choose which sector they go to work in, and this choice is going to have an impact on their stock of human capital. Finally, the model also features additional externality that comes in the form of spillovers to sector-level productivity that depends on the share of skilled human capital. Those externalities are largely literature motivated. Since I'm thinking about the endogenous decisions to acquire education, I also want to consider what are the additional externalities coming out of this choice that the workers do not internalize. Those frictions are going to be different by sector. So the model is going to feature that for some sectors like construction, maybe those spillovers are not as important as for let's say high skill services. Okay, so I'm going to first talk about the production. It's very simple, and then I will move to the workers' problem. Production is going to be a closed economy here, and it's going to feature production sectors plus education and non-employment. So education is going to be its own sector where you go to if you want to become skilled. Non-employment is your outside option. In each of the production sectors, this is the production technology. It's going to combine two inputs, the total number of unskilled and skilled efficiency units of labor, and it's going to be a Cobb-Douglas with concentrations to scale. Here's what exactly the spillovers look like. The sector level productivity, ZGT, is going to depend on some time invariant component. I'll think about this as TFP. And then it's going to also depend on the share of the skilled efficiency units. And this parameter eta j, which is sector specific, that's going to be the extent to which the spillovers matter. So intuitively, it's a static spillover. So in every time period, what's going to happen if you have more skilled workers coming into the sector, if the share increases, the productivity of all the workers increases. That's all about the production. So there are no firms here. It's just this aggregate production function that combines efficiency units. So now, what is the worker choices, and how does the individual human capital of workers change over the life cycle? The human capital is defined by two things. The first one is the skill level. So that's your choice of education, whether you're unskilled or skilled. And there is efficiency units, which is a scalar that you carry over, something that you can accumulate while staying on the job, for example. If the worker chooses to get education, first she becomes skilled for the rest of her lifetime. And I'm assuming that in this case, the worker just carries over the existing efficiency units. So then, as opposed to that, if the worker is moving between other sectors, either production sectors or unemployment, the skill level now stays the same, but the efficiency units change. And this is the law of motion that governs how exactly the efficiency units change in this case. Let's imagine we have the worker with efficiency units HT, and then she moves between sectors J and I. The new human capital is going to be a fraction of the previous period one. And this fraction, the tau JI, so it is, you can see, bilateral between every two sectors JIs. There is this parameter that needs to be calibrated, and it's also skill specific. So I'm assuming that there are potentially different law of motions for unskilled and skilled workers for accumulating capital. If it is larger than 1, it means that you're accumulating human capital. If it is less than 1, it means that there is some depreciation. So you can imagine, for example, that if you are unskilled and you move outside of construction, you're losing a large fraction of those efficiency units. Yep.
Thanks for that, Laura Kings.
Yes.
That's a rolling model with human capital. I thought you're not going to bring any observer heterogeneity. I mean, you might think that the people went to construction, but those that were less able to.
Yeah, thank you. That's good. So here, everyone is born with the same initial stock of human capital. The only heterogeneity that we see is an exposed heterogeneity from different paths that the workers take. And I would say that the way I defend this assumption is that if you look at the decline in enrollment, which is 50%, it's really not that much about the marginal student who drops out of college as opposed to if it was much smaller. But I do agree that potential heterogeneity and ability plays an important role here as well. Oh, I see what you mean. Okay. Yeah. No, that's good. I mean, yeah, thank you very much. No, that's a good point as well. Yeah, and I think that both for this comment and for the underlying heterogeneity and ability, if I had much more data than this, that would be nice to also estimate. Okay, so now let me just summarize what the worker is doing over the life. Please.
So
yeah,
there's literature highlighting that how much you get out of going to school is negatively correlated to the size of the cohort you go to school with. That margin is not here, I guess, that you still go to school to actually get more out of it because there's not as much competition for resources in school.
I see. Oh, so you mean not just the cohort like population, but the cohort that you actually end up in college with? And no, for sure. Yeah. So here, education, there's nothing about like production function of education or anything like in terms of your boost to human capital, right? I'm assuming specifically that you just carry over the efficiency units. I think here about education more of a, I guess, signaling mechanism. You become skilled, you qualify as a different input into production, you go into a different labor market. That's the only role that education plays here. But for sure, if you really carefully want to think about your changes in income once you get education, that would be also very important thing. Okay, so summarizing, the worker is going to be described by their skill L, the stock of efficiency units H, the age A, and then the current sector of employment J. In each period, they get utility from consumption. Everyone is hand to mouth. So I'm abstracting from savings behavior here. And their income is proportional to stock of efficiency units H. There's a unitary wage here, WLJT. In every period, there's only one choice that the worker is making, and that's the choice of which sector I go to next. And that could be education. If you're unskilled, you can go and then become skilled. If you're skilled, you're just choosing between different production sectors and an outside option. So upon a switch into sector I, there's some utility cost chi that you incur, which are also age specific here. And then the value function, the value that you're getting in the next period that features this H prime, which changes according to the law of motion that I showed you before. All of these choices are made subject to some idiosyncratic preference shocks that are drawn from the Weibull distribution. What else do I need to mention here? Yeah, and everyone is hand to mouth and has CS preference over different sectoral goods. Okay.
How important do you think this assumption is that everyone's hand to mouth? I mean, so the extreme financial constraints, I mean, normally financial constraints sort of matter in education type models. So,
yeah, it is. I think it's super relevant. Thank you. It's very important for being able to solve this model in an much easier way and then simplify it. That's let me say that. So the particular law of motion that I have here, everyone being hand to mouth, having CRA utility, that is all going to play out very nicely into simplifying the value function and primarily taking out the efficiency unit H. In the way that I think about this is in Spain, we can argue whether financial constraints are very important for also like consumption smoothing and everything in such a shock. But in terms of education, at least it is a heavily subsidized environment, higher education. So I would say that maybe it's not the primary concern. In terms of the mechanism that I'm studying, I'm going to be focusing on the opportunity cost. So that's also one of the reasons.
I mean, I think I meant something similar, which is it makes a lot of sense that there would be financial constraints, obviously, in education, but I guess yours is just very extreme in the sense that you cannot avoid all of my questions. Do you think your results would change if you had less experience with financial constraints? Do you think it's an important assumption, or it's like one of these?
There is a subsidy that everyone is getting to consume while they're in education. So in that sense, it would depend on what is the cost of getting education. So of course, I think that the quantitative magnitude will change. Yeah, in terms of the mechanism, this mechanism will still be present. It will be again, we need to think. I think then it would be very relevant to think about heterogeneity, maybe inability, and thinking about how different workers are differentially affected by the shock. Yeah, thank you. Okay, so this is the workers' problem. Now, as I mentioned, the several assumptions are they give me the value function, which is homogeneous in the efficiency units H, that allows me to take it out of the value function, and then it will only depend on the states, which are the skill level, the age group of the worker, and the sector of employment, which is now everything is observable, very easily can be measured in the data. This together with having idiosyncratic shocks drawn from the Weibull distribution that gives me the closed form for the switching probabilities in between every pair of sectors J and I, that again is skill specific, age specific. But the nice thing about this object is that we can go to the data, we can directly measure that, and I'm going to use it to incur the utility costs guys. Okay. So this is basically all I wanted to say about the workers. Now let me sort of close the model back and aggregate up once we have the optimal choices of the workers to.
I just want to ask they might have already said. So when I'm deciding to go to college, I'm taking the present value of the benefits I get for my skill premium relative to the cost of going to college today, which is basically the foregone earnings. That's the trade-off that I'm making when I'm making decisions to go to college.
Yeah, that's the main thing. You're projecting what you're going to earn as an unskilled worker if you go to a particular sector, if you stay in the same. Yes, yeah, it is a fully forward-looking. Yes.
Question is already in there, and they're doing it, and they get to eat while they go to college. So it is already like there's the
in that,
I don't think it's doing anything. If they're able to eat, right?
I think the hand-to-mouthness doesn't interact with the education choice for efficiency reasons, in the sense that by changing the distribution of skills in the economy, you're gonna change the effective labor supply curves. You're just gonna change the nature of labor income risk, because the wages are gonna be moving around differentially because of the human capital accumulation piece. And that then's gonna interact with the very strong incomplete market of not being able to consume. So it might matter for efficiency, but I agree that it probably doesn't matter at all for, well, it matters some, but for the potentially on bad educational choices.
And then there's a cost to going, like a utility cost to going to college that makes 26-year-olds not want to go, but 25-year-olds do, or whatever you said. Okay.
Yeah, there is a switching cost, utility cost, this one, the KIGI, and it's age specific. So it is just, this is helping to.
Some other sector is part of this.
That,
cost as well.
yes, that,
Gotcha.
yeah. So the one thing that the workers are considering is the law of motion for human capital, how much they're going to be able to earn. But, and the other one is the utility cost of that is per period sunk utility cost. Yeah, thanks. Okay, so now that we have the optimal, the solution to the workers' problem, which is those shares mu, ij, the switching probabilities of moving between every sector, we can basically aggregate up to see how the aggregate human capital of unskilled and skilled workers changes in each sector. It's going to be just this share times the transferability parameter times all the human capital that they bring from all other sectors, i's into j. This is for the unskilled. For the skilled, the first component is very similar, all the human capital being brought from the previous period from other sectors, plus the newly educated people that come out as skilled in this period. Finally, I added over different ages, and I get those aggregate stock of efficiency units, LUJT, LSJT. If you remember, those were the two inputs into the production function. So now we have sort of almost closed the model. So I just want to highlight briefly that, again, it's a full general equilibrium setup where in the absence of any aggregate shocks, the economy is in the steady state. There is a stationary distribution of human capital across different sectors. And now I'm going to feed in the aggregate shocks, demand shocks to different sectors and solve for the transition dynamics afterwards. Okay, so I have very little time left, and I only have this one slide for calibration. I'm not going to comment much on it. I just say that some of the parameters are standard to the literature. The parameters that are very specific to this model, and I'm estimating them using Spanish data, are those transferability matrices taus, the switching cost, the spillover parameters. Yep, please.
If you were to stress one thing that kind of deviates the individual from planners, what they would want to do, would it be these within sector spillovers that the high skill is really spilling over on other people, or would it be some other?
Thanks. No, that's very good. I mean, in terms of, yeah, like a standard, the spillovers are and a very obvious externality here, and this is what the social planner would want to offset because everyone is sort of underinvesting potentially in their education. I guess in terms of, if the question is what we think of what should be the social planner's objective, because we have a dynamic transition period where different cohorts live in this economy under different shocks. And if we think about the sort of one-time shock and then how the economy converges back, then the question is, well, if the different cohorts are differentially impacted, maybe the social planner wants to correct for this missing intergenerational market. Yeah, thanks. But I'm not solving formally for this optimal policy, partly because I have questions myself. What should I think about the planner? Like, how should the planner discount different cohorts' welfare and earnings here? Okay, so the benchmark quantitative analysis is going to be sort of feeding in the construction boom and solving for the transition of the economy. What exactly is the boom in the model? I'm going to have a very particular way of modeling it, which is the preference shock to consumers. And the parameters that I'm going to change are the sectoral demand shifters. So the aggregate consumption is the CES over all the sectoral goods. And by changing those sectoral demand shifters, VJT, sort of we're going to affect the relative demand for different sectors. And then also changing the discount factor will intuitively shift the aggregate demand in this economy. Obviously, if and I think I need to comment on that, if we think about the real episode in Spain and what is the source of the shock, then I would say yes, it should be a small open economy with the current account deficits and decline in the interest rates. But this setting is going to be isomorphic to the extent that it has the same effects on the consumption, on demand for labor, and here as well, I guess the abstracting from saving and borrowing decision does not create any additional problems. So I'm going to calibrate this shock to match the initial increase in GDP and change in the sectoral GDP shares. I'm not going to be, so the taking the model at the stock, I'm targeting everything in the steady state, the lifetime allocation, and I'm going to be targeting the initial increase in GDP and shares. I'm not going to be targeting anything else along the transition. That means not going to be targeting educational response, employment, productivity, anything else. So that's going to be the sort of the validation of the model. And importantly, I assume that the workers do not anticipate the shock, but they're going to have a perfect foresight about the duration of the shock. In the paper, I also do the myopic agents case to sort of provide two different benchmarks for this. So in the last almost 5 minutes left, let me show you what the education response is in this model following the boom. So the boom lasts for 2 periods in the model that corresponds to 10 years in data. And then there is a transition. With the perfect foresight, you can see that there is an initial decline in educational attainment of young workers, but then in anticipation of the bust, it increases in the second period of the boom, basically. So that obviously in the myopic agent case is going to match the data much better. But in terms of the magnitude of this initial decline, the model actually replicates pretty well what we see in the data, those 15 percentage points. We also do see them here. Let me skip to the aggregate productivity, because this is the slide that I started with as a motivation. So here's what the model predicts for the changes in cumulative labor productivity. 0 is the steady state level, and now we're thinking about the deviations from that. So there is a persistent decline, as I mentioned. The convergence takes about 55 years, and this is not a magic number. 50 years is the lifetime of one cohort. So with a perfect foresight, these effects, they persist up until the moment this cohort affected by the boom exits the economy. In terms of the forces that contribute to this decline, there is, first of all, an increase in labor force participation, which happens through younger workers that enter with less accumulated human capital. So that sort of mechanically contributes to the decline. And then if you think about the role of those spillovers, it's actually different during the boom period than the bust. So what happens during the boom is, as the more people join the construction sector, the share of skilled workers in high skill sectors increases a lot, and it's mostly older workers staying there. So, and those sectors have larger magnitude of the spillovers. So it actually partially offsets the decline in the productivity during the boom. Now, what happens after the bust is the opposite, because we have the people get locked into the construction, those young people who did not go to college, they stay there under accumulating human capital throughout their life cycle. So that's, again, like the direct effect that decreases productivity. But on top of that, there is sort of the under-realization of the spillovers, because more people stay in the construction sector. So that's going to amplify the decline. Finally, let me show you one last fact for the benchmark case, which is the distributional effects. I'm going to be focusing on the lifetime earnings of different cohorts, and 0 is the cohort born at the start of the boom. Then to the left, everyone born before, and then after year 10, everyone born after. So we do see that people who are born during the boom, who enter the economy during the boom, are actually the ones who are better off as a result. And this, we're thinking about the lifetime earnings here only, right? So those are people who enter with less accumulated human capital, but they do enjoy very high returns to their labor during the boom, and that turns out to be enough for them to be better off in terms of lifetime outcomes as well. Now, what happens to the people who enter the economy right after the bust? They're the ones who enter after the shock disappears, and there's no shock anymore in the economy. They invest in their education, as in the steady state. They can freely allocate to any sector of the economy, yet there's a lot of congestion in the labor market. The labor force still stays larger than in the steady state. So the wages, there is a downward effect on the wages for those several cohorts. Okay, so in the last minute, there are several counterfactuals that I investigate in the model, and one extension, which I already briefly commented in a couple of times with myopic agents. that help to understand what is actually the forces behind this mechanism, but also how far can we take it in terms of quantitative predictions with different calibrations of the model. And concluding, this paper shows investigates how human capital accumulation can generate persistent effects from temporary sectoral shocks. It provides empirical evidence for this mechanism to be present in the case of Spanish economic boom, and introduces a general quantitative life cycle model which features endogenous human capital accumulation through education and sector choices. The main takeaways that I want you to take from this exercise is that despite the fact that this is a positive shock, right? It's a shock with increase in real GDP, GDP per capita. We can still see some negative effects on the productivity, on the aggregate productivity along the transition resulting from it. And those turn out to be quite persistent, with transition taking over the life cycle of one cohort of 50 years in this case. And 0.8%, you might say that this is not a very large number, and I would completely agree with that. So quantitatively, that gap that I showed you in the data is not closed even by, I don't know, 1/3 with this mechanism. But yet the distributional effects can be quite large, and there is a lot of variation in how different cohorts are impacted by the boom. So this is where it comes to thinking about what are the potential policy implications of this. Thank you very much. Thank you for all the comments. Just say one thing.
We're seeing whether you prefer his whistle or my yelling. Those are the two options we have on the stage. Just for those who are coming in now, whatever.
People struggled.
6:30, same place as last year. When we finish, Summer will put it up on that slide, right up there, and you can take a picture. But Portico Brewing, same place as last year, 6:30. They have tacos and they have beer, and that is what we got. Is that what I say, right? They're hard people. We have John now talking about how sectoral shifts affect workers. Here we go.
All right, great. Well, thank you very much for putting this paper on the program and for all of you to coming to see it. This is joint work with Nathan Zorzi, who's here in the audience and taking notes of all of our interactions. So please be nice so we remember it well. So we're thinking today about how rapid sectoral shifts affect workers. So sectoral shifts, that is periods where labor demand gradually moves across different sectors, rises in one sector and declines in another, are ubiquitous throughout economic history. You can think about, sectoral change, shifts from manufacturing towards services. You can also think about more micro events, such as a shift from physical retail stores towards warehousing. And particularly policy relevant for today might be the shift away from polluting sectors and towards clean sectors that we might have to do if we have to undergo a climate transition. Now, these sectoral shifts invariably involve labor reallocation between these different industries. And what's more, we know that labor reallocation can be quite costly to workers, both because they have some specific human capital to the jobs that they're leaving that they can't transfer, and because that reallocation process might be frictional in a way, involve periods of unemployment that we know can have lasting effects on workers' earnings. And so the prospect of these costs fuel a lot of concerns about how quickly we might want these shifts to occur. In particular, in the climate application, for instance, you can look at survey evidence on people's opposition or support for ambitious climate policies. And one of the major concerns that comes out of those surveys is the perceived labor market costs that are going to be imposed on the 10 to 15 million workers employed in polluting sectors if we were to try to have a very fast timeline. You can also see it from voting records in the climate context. And so despite this sort of centrality of this question of like how fast do we want this to occur, I would say we know relatively little about how these different transition timelines affect workers' outcomes. So for instance, in the context of the climate transition, if we were to have a climate transition that ended in 2060 or 2050 or 2040, what's going to be the effect on workers' earnings and the distribution of workers' earnings? Or more generally, how does the pace of a sectoral shift affect the workers who are most at risk of displacement from the declining jobs? Which workers might support each timeline? And how expensive might it be to compensate those workers for the lost labor income? In particular, you have other policy goals in mind, such as the rapid climate transition. So our goal for this paper is trying to provide some conceptual insights that we think kind of apply broadly for some sectoral shifts, but then we're going to have a particular quantitative application of the climate transition, which of course we think is very important. So we're going to write down a model that's designed to capture the displacement and reemployment experiences employed in these sort of declining industries. It's going to have finite lives, so life cycles, and heterogeneous skills across multiple sectors. Those are two really, really key features we're going to spend a lot of time talking about. We're also going to have job ladders and frictional labor markets, so workers can be both employed or unemployed and climb a ladder over time for a number of our analyses. And then we're going to feed into this model a sectoral shift, whereby labor demand is going to gradually decline in one set of jobs and rise in another set of jobs. And then we're going to ask a counterfactual question, which is what's going to happen if those shifts in labor demand happen more or less rapidly, such that the transition is completed sooner or potentially later. And this exercise ended up teaching us a couple of things I found quite interesting and personally unintuitive. The first is that workers' outcomes are going to be highly nonlinear or even non-monotone in the pace at which the transition unfolds. So putting that into human language, if you were to try and complete the transition 1 year earlier or 5 years earlier or 10 years earlier, you're going to have vastly different effects on workers' lifetime incomes. The non-monotonicity, in fact, is going to be a U-shape. What that's going to imply is you want to beware of these medium speed transitions. That's going to be worst case scenario for a lot of workers. Why? Because they're going to experience all of the displacement from the declining industry, but not actually have the transition to be too slow for them to realize any benefits from the growing sector before they retire. And so these medium speed transitions are kind of worst case scenarios for these workers. And that's, that's what drives this non-monotonicity. Almost a consequence of that is some interesting political economy implications, where policymakers are generally going to be facing a trade-off between having more winners on the extensive margin versus a thicker tail of losers on the intensive margin as you start accelerating the transition. What's happening there is that as the transition accelerates more and more people are going to have switched into the growing sector before they retire, and then they're going to want to go even faster at that point. But the people who can't switch are just getting hammered more and more and more as you're accelerating the transition. So you generate this trade-off between the extensive and intensive margin of winners and losers, which of course has important political economy implications when we think about how policy is set. And then the third insight that this exercise taught us is that accounting for labor market frictions is really essential to understand how these lifetime earnings changes evolve in response to the pace of the transition non-linearly. So empirically, we kind of already knew that unemployment and job ladders are very important to understand earnings losses from job displacement in kind of a steady state sense. What we're finding is that it's also important to account for these frictions if we think about how those earnings losses change non-linearly with the speed of which a sort of medium run shift occurs in the economy. So we think these three things apply kind of generally to various kinds of transitions, but we're going to have a quantitative application and ask what's going to happen in the US if the climate transitions ended in 2060 or 2050, et cetera. So briefly on literature, there's a lot of work thinking about particular sectoral shifts and analyzing transition dynamics in response to those shifts and how it affects labor markets. We're really asking kind of a different question. We're asking a counterfactual question. What if we change with the pace at which those labor demand shifts occurred in the first place? And we're also going to bring to bear kind of a frontier labor market model, which has these job ladder features. That model is going to borrow heavily from a lot of the ingredients that the literature on the cost of labor displacement, losing your jobs, emphasize are really important. But again, we're going to be asking this sort of more counterfactual question rather than a steady state question or a business cycle question. And then, of course, we're applying to the growing literature on the macro of climate change. Jim and Adrian wrote a nice paper last year, which is a survey of that literature, and they conclude what much more work is needed to assess the impact of the energy transition on workers and labor market reallocation, and that's what we're doing. So the plan for today is I want to first explain the economics as cleanly as possible in a frictionless benchmark, where there's none of these labor market frictions and everything's going to be very transparent. And then I'm going to bring back in these labor market frictions, tell you they actually still really matter quantitatively, and then we'll do the application. Okay. So when we work in this frictionless benchmark, well, throughout, when we're working in continuous time, indexed by T, we're going to be thinking about there being two primary sectors, which are going to index by K. I'm going to call one sector D for declining, or with an eye to the climate application, dirty, and one sector C, which is, job creating or clean, right? And these sectors are going to be having labor demand moving over time, which generates these sectoral shifts in a way that I'll make explicit on the next slide. Now, these two sectors are going to be combined to produce a final numeric consumption good using a production function F, which has a T subscript. You can think of this, for instance, as a CES production function between the two goods with kind of time varying weights. Maybe we care more about one kind of good or another, and that's what generates a shift in activity between these sectors. These intermediate goods, the goods that are produced by the sectors, are produced by combining capital and labor with we put a Cobb-Douglas production technology. Now, it's not super important. The capital is going to be accumulated according to a standard law of motion. There's going to be investments that are subject to convex costs. That means that capital is going to adjust relatively slowly. It's not just going to jump to a long run level. And then capital is going to have to obey a law of motion such that it depreciates over time and is accumulated through this investment process. That's all fairly standard. The interesting part of what we're going to be doing, we're all focused on the labor market, is going to be labor side. So let me tell you about the workers. Workers are going to differ in two primary ways. First, they're going to have different cohorts in an overlapping generation structure. So this tau is going to index a worker's cohort, and each worker is going to live for J years. They're going to have completely standard preferences. We're going to discount at a rate rho over their J years of life, and everything I'm going to show you today is using risk-neutral workers. So we can just think about workers caring about the expected present discounted values of their labor income. So they differ in terms of the cohort. They're also going to differ in terms of the skills that they have in the two different sectors. That's what the psi of K is representing. It's the number of units of human capital that I have in sector K. Now, for now, again, to make things as transparent and easy as possible in this frictionless benchmark, I'm going to normalize everyone's skill in the D sector to be 1. And then they're going to have a heterogeneous draw of a psi hat, the amount of skill that you have in the C sector. Psi hat is one piece of notation I want you to remember. It's going to come up a lot. Throughout the talk, it's going to be the relative skill that you have in the C sector versus the D sector. For now, again, in this frictionless benchmark, I'm going to think of these psi hats as being endowed at birth and fixed over your lifetime. When we go to the quantitative model, that's going to evolve endogenously through a skill accumulation process. Yeah, Greg?
Okay, but kind of understand at the industry level what the difference is between dirty and clean. I think it's got two different ways of generating energy, but I'm having a hard time mapping those onto skills that are embodied with workers. So do you have any examples that I can catch on to?
Sure, yeah, so maybe let's think about the car sector, for instance. So you might want to build internal combustion engines cars or electric vehicles. Then, okay, so in that case, electric vehicles have a lot of components that are not present in internal combustion engine vehicles and vice versa, which might require different assembly skills as you do that, or different inputs that you need to know how to work with a battery rather than work with oil fuel injectors and things like that. And so that's what's going to generate these sort of switching costs between different industries.
Right now, before we get to dirty and clean, that's an application.
That's
right
an
now. Could I
application.
just be thinking manufacturing in my head and then services?
Yes, if you want to, you could think manufacturing and services. At this point, there's just two big sectors that become important.
I'm gonna want to come back to Greg's question, but right now it is at the.
Absolutely, and then that's going to end up being a question of how do we discipline the distribution of the sci-hats and everything else, and I'll tell you, of course, how we do that. But yeah, just think of now as there's two sectors, and there's specific human capital on some sense between those two sectors, and then we can think about the specific applications as we go. Okay, that's skills. Again, for now, I've already previewed, this is a frictionless benchmark to try and build intuition. So I'm going to be working with competitive labor markets. Workers are going to be able to work in only one sector at a time, but they can freely choose which sector they work in at any instant, and they're going to be paid the marginal revenue product of labor. Okay, finally, there's going to be a government that's going to be able to subsidize, have sector-specific subsidies on the investment in these different sectors to speed up or slow down the transition. And we're also going to give it access to some lump sum taxes that it can levy on the entrepreneurs that operate these technologies, just so we can abstract from them on the worker side. Okay, so let me tell you about what that's a framework. Let me tell you what the exercises we're going to run in this framework are going to be. We're going to feed into this model a sectoral shift. What's a sectoral shift? Well, beginning in period T equals 0, there's going to be some change in this final good production technology. You can think of it as changes in preferences or something like that. That's going to shift economic activity from the D sector towards the C sector. So, what that's going to do is going to shift labor demand gradually such that it declines in the D sector and rises in the C sector. What's labor demand? Well, in this model, as in many models, it's summarized by the marginal revenue product of labor in the two different sectors. So I've just written that out, what that is here. Marginal revenue product of labor, again, as usual, is going to be the price at which that sector can sell its output to the final good producer, which itself is equal to the partial derivative of the F with respect to the K's input, times the physical marginal product of labor in that sector, which is going to be a function of the degree of diminishing returns to labor, 1 minus alpha, and the amount of capital that gets accumulated in that sector over time through its capital accumulation process. Now, one other piece of notation I want you to remember is the ATK. ATK is just my shorthand for the marginal revenue product of labor in sector T in sector K in period T. And what's going to be really useful for us is that these ATKs, these marginal revenue products of labor, are going to kind of encode everything we need to know about the labor demand side in order to characterize workers' outcomes. It's going to tell us what workers' earnings could be if they chose to work in our sector, and therefore it's going to encode how much they are going to reallocate to those sectors. And conditional on the ATKs, I don't need to know specifically what the Ks are, so I don't need to keep track of them. In some sense, these ATKs are sufficient statistics for our exercise, and it's going to be a very convenient modeling tool to try and express what our transitions are going to look like. So in particular, we could think of what a status quo shift is going to be, is a path of the ATKs, a path of the MRPLs, that's going to prevail under the current expected policy regime. And then we can express counterfactuals as different paths of these ATKs that are induced by the government doing short-run subsidies to the investment process in these two different sectors, such that transition, that shift occurs more rapidly or slower and sort of ends sooner or later. So let me sort of show you what that's going to end up looking like. Let me start by explaining what a status quo transition might look like. Here, we're plotting a path of these A's in the two different sectors. A sectoral shift is just defined such to be a period in which the A's are rising in the C sector in blue and declining gradually in D up until they end up at some long-run level. Yep, Adrian?
Just wanted to understand how you think about the general equilibrium here.
Mm-hmm.
So you take them solution statistics, but in the general equilibrium, there's sort of endogenous.
Mm-hmm.
What's your
Yes, that is exactly right. That is what's going on here as workers reallocate between the sectors. Of course, with diminishing returns, which changes the MRPLs, that might feed back into the capital accumulation process, et cetera, et cetera. It's certainly easy to understand, I hope, that in the status quo, that's the ATK is still all we need to know. What we end up showing in the paper, and I'll talk about this in a second, is that the government can implement different paths and different speeds of the ATKs just by using its short-run subsidies even accounting for all these reallocation patterns. And so that still remains a sufficient statistic in general equilibrium via these subsidies. Hey, Joe?
Sorry, John, a simple question. Is the level of DTK going to be relevant or just a ratio of them? Related allocations, relative wages are going to
Yes, the ratio is going to end up being what matters for the earnings losses or gains arising from the transition relative to there not being a transition. Certainly, the level of your earnings are going to be affected by the A's, but in terms of the changes as resulting from the transition, the relative is what matters. Great. Okay. So this is kind of what a status quo transition looks like. I've normalized the initial level of these A's to 1 in both sectors. So it's kind of easy to think why that's a normalization in, say, the D sector. It's just the scale of the economy. So this is kind of to your point there, Joao. I'm going to argue it's also a, without loss of generality, normalization in the C sector. Why? Because if I see people are really marginally productive in that sector, I can't tell you if it's because the marginal revenue product of labor as a whole in that sector are high, or just everyone has a lot of labor units in that sector and are very skilled there. So I have to normalize either a level of skills or a level of the MRPLs. I'm going to choose a normalized level of the MRPLs. After that initialization, starting the sectoral shifts, we've drawn it here such that it has an S-curve shaped transition that kind of matches on the work that Grillikis did in the 50s about these technological transitions. You tend to see these S shapes. But the S shape turns out is definitely not important to any of the results we have. We have versions with linear, et cetera, et cetera. And then motivated by the climate application, I want to make a couple of choices to make the date on the horizontal axis concrete and just sort of build more tangibility to what we're doing. So the Kyoto Protocol entered into force in 2005. That was kind of the first major climate agreement. So we're going to have our initial period correspond to January 2005. And of course, we had the Paris Agreement, where a number of countries, including the US, signed on to have net zero by 2050. We're not on track for that. It will probably surprise no one. So the recent Bain & Company survey of energy executives said the most likely outcome is it will end our climate transition by 2060. And as a result, that's what our benchmark status quo transition is going to be, starting in 2005, going to 2060. Now, in the frictionless benchmark that we've been considering for this first part of the talk, workers are going to be paid their marginal product. What's their marginal product? Well, if they work in D, it's just going to be the ATDs because they have 1 unit of skill there. If they work in C, it's going to be the ATCs scaled down or potentially up if they have psi hat bigger than 1 by their psi hats, their relative skills. Okay, so that's depicted here by this dashed line. Now, the counterfactuals we're going to consider is, what happens if we speed up, compress the timeline over which these transitions unfold, starting from some initial period T0. So say starting from 2025, we're going to accelerate or slow the transition. And what's going to be the effect of that acceleration on workers' outcomes? Say if the transition were to be completed 1 year earlier, 5 years earlier, 10 years earlier. Yeah, Yu-Cheng?
I guess you are doing some perfect foresight
Mhm.
work, but as you just mentioned, for the climate transition phase, there is a huge uncertainty over time when the transition phase will really be. So it seems that the uncertainty about the transition phase is really important in shaping people's decision here.
Yeah, super great question. Absolutely. So what I'm going to show you in this frictionless benchmark for workers, it's not going to matter, right? Because workers are going to be able to make period by period static choices about where do I want to be at this particular point in time. Now, you might say it will matter for the investment process, which will affect the shape of these A's, et cetera, et cetera. But that's all affecting how the A's look, not how workers respond to those A's in the frictionless benchmark. When we end up introducing frictions, all of the occupation switching decisions, et cetera, and skill accumulation and things, those are all going to become forward-looking, and we're going to live in the world where we have perfect foresight. We could consider alternatives, but we haven't done that yet. Like full uncertainty is going to be a bit difficult, but maybe we could do the opposite where we think myopia or something like that. Yeah.
Maybe something this exercise. So the quantities depend on the system social vocabulary and labor. You can have Dutch disease or the other thing. So in other words, the shrinking sector maybe actually be absorbing more labor. We care about the number of people times this here. Yeah. So there should be another graph because of what employment.
So employment is going to be a result of all the labor supply decisions that these workers are going to end up making, right? So
where more employment goes in the shrinking one or the rising one depends on Dutch disease, depends on the system.
Absolutely, but all those kinds of dynamics are only going to affect the employment levels via their effect on the marginal revenue product of labor. So fair.
There could be 2 cases. Now the transition is faster, it's better, or worse, depending on which case you're in. So which one do you have in mind? That the shrinking sector in Amplia is also losing workers?
That's the idea we have in mind, because that's,
It's expanding and you have this lower because it's a less decision.
you could imagine stories where either would be the case, and our application, of course, is going to be to climate, and we kind of think what's going to end up happening there is that we're going to move workers out of the dirty sector and towards the clean sector. But broadly speaking, what's going to end up mattering, workers are still going to move to the places where they're going to be paid the highest, which is related to the MRPLs.
So for this graph, you should think about that.
Think about that case for if that's the easiest way to be concrete. Yeah, Lucas?
So in order, for this, if this is a policy margin, then I guess the government would have to introduce certain distortions in order to achieve this faster path of adjustment, right? So to what extent do you want us to think about those distortions, and why aren't those distortions the more relevant margin if you want to assess different types of speeds of transition rather than the worker relocation?
Yeah, I was going to talk about this in a second, but I'll talk about it now. So absolutely, I've drawn some pictures here about like an accelerating transition. I'll tell you exactly what that is in a second after I answer this question. But the government's going to be able to implement these kinds of exercises using these short-run taxes and subsidies. That is, of course, could carry some costs associated with it. We solve in the paper and in that button exactly what those subsidies and taxes need to be in order to implement our paths. I want to be very clear that what we're after here is really a positive analysis. We're trying to understand how a more rapid movement in these MRPLs is going to end up shifting workers' labor market outcomes. The question you're asking is really important to try and understand what an optimal policy should look like, because there's going to be these other distortions going on. That policy question is, of course, really interesting, but it's very difficult, I would say, both conceptually and empirically, because we need to take a stand on who we're going to be compensating, what the Pareto weights are for those different workers. Is there time consistency in the policy when you have different generations coming in, potentially with different skill mixes or whatever, as they accumulate the skills over time? So that's a very hard question. And for that question, we definitely want to take into account the distortions. But from the perspective of just the positive analysis of we're changing the rate at which labor demand moves, what's going to happen to workers, I think what matters is really these paths of these A's would be my answer to that. Okay, so let me tell you how we're going to actualize these faster paths. Well, we can think about what the status quo transition, the solid lines are, as being some initial level, A0, which is 1, of course, and in the long run, we're going to end up at some A infinity. And then there's some function that kind of encodes how far along we are between A0 and A infinity. So this phi sort of represents the share of the transition that's completed as of a period t under the status quo. Now, the counterfactual we're going to express by just changing the argument of that phi function by plugging in this eta term. So if eta is equal to 1, that's a parameter equal to 1, then we're going to get phi of t back, right? So we get right back to our status quo. If eta is bigger than 1, then things that are happening further in the future are going to start to happen closer to today. So we're going to be compressing the timeline over which the transition is occurring. And that's how we're going to sort of parameterize these counterfactuals. As I sort of just mentioned, that's something the government can implement using short-run subsidies. And if there are, if they're sufficiently substitutable, to Giuseppe's question, these kinds of short-run subsidies will also matter. A short-run subsidy to one sector will also generate these kind of double deviations between the two through the relative price effects. So we think that's kind of a natural exercise for us to consider. It's also something that seems quite relevant in the climate case. Okay, so I just all said this. So I think this is, this positive analysis is a really crucial and interesting first step to try and understand what the effect of a more rapid sectoral shifts would be on the earnings distribution. Okay, so that's what we're going to be doing. Let me now tell you what's going to play out as the economic mechanisms at play as we start changing the pace of this transition. So I'm going to start by just understanding the status quo transition. So what I'm plotting on this plot is a worker's income over the course of the transition for a particular worker type. Now, workers are going to go to the place frictionlessly where they're paid the highest, which is where they're most marginally productive. And so that at a certain point, they're going to become more marginally productive, potentially in the C sector, and therefore they're going to switch there at some stopping time that depends on their level of relative skills. While they're in the D sector, their earnings are going to decline following the path of the ATDs, and they're going to rise following the path of the ATCs when they're there. And workers with different levels of relative skills are going to switch at different times. If you have more specific skills, you're going to switch later, or if ever, you have psi hat equal to 0, you never switch. Workers with higher skills are going to switch sooner, and they may even realize some long-run benefits, sort of in a flow sense, arising from this transition. Okay, so we want to think about lifetime earnings, which is what workers care about in this model. If we want to think about the change in the lifetime earnings arising from the status quo transition, we want to think about the area between the realized path of earnings and 1, which is what they would earn if there were no transition at all and the A's are fixed at 1 forever. Appropriately discounted up until they retire, of course. Now, if I were to accelerate the transition, make it so it ends in, say, 2050 rather than 2060, that's going to have 2 effects on workers' earnings. The first is you're going to have a steeper decline in your income while you're in the D sector, which clearly you don't like. But on the other hand, you're going to switch to the C sector sooner, and you're going to realize better outcomes while you're there, which you like. And so these 2 forces kind of work in opposite directions, and that's what leads to our first sort of conceptual insight about this nonlinearity and non-monotonicity. So let me walk you through that. What I'm plotting on the left picture here, the horizontal axis, is the end date of a counterfactual transition. So if I go further to the left on that plot, I have faster transitions, and further to right is slower transitions. The vertical axis is the change in your lifetime earnings that arises from that counterfactual transition horizon relative to the earnings you would have under a status quo transition. Effectively, it's the difference between the dotted area and the gray area on the right. Okay, so just to make sure you understand what's going on, all of these lines are going to end up going through 0 at 2060 because the difference between status quo and 2060 is the status quo and counterfactual transition ending in 2060 is 0. Okay, now each of these lines correspond to different levels of psi hats, fixing an age at which the transition's unfolding, or fixing the age of the worker, and we'll do a complementary analysis in a second. But what you can see is that all of these lines are highly nonlinear or even non-monotone in the transition horizon. I'm going to touch the remote for the first time gingerly. So if you look, for instance, at the solid line here, corresponding to 6.69, the number doesn't really matter too much at this point. You can see it's very much flat for small changes in the transition horizon, but as you go faster and faster, people can actually start to realize pretty sizable earnings changes in lifetime as a result of a faster or slower transition. The nonlinearity implies that extrapolating from small changes from, say, 2060 to 2059 can be quite misleading. Accelerating by 1 or 10 years is going to be very different. The non-monotonicity means you want to be aware of these medium speed transitions, which is just fast enough that workers lose from the declining sector, but not so fast that they can benefit from the C sector. So what's the intuition for where that's coming from? I think it's easiest to see from this plot, which is the same plot, but for different ages rather than different psi hats. You can see that all different ages are, of course, going to value different transition horizons differently. Why? Because the older workers have less time to recoup the losses they suffer early on in the transition. And as a result, they only benefit marginally from extremely fast transitions, whereas younger workers might be willing to wait and have, medium speed transitions, and that would be where their U-shape is. So I think this is the best place to think about where the U-shape comes from, because I can now play with this retirement line. So suppose that you were a worker who was going to retire at exactly the point when exactly your T-star, exactly the moment you would have switched between the sectors. So in that case, you're going to spend your entire career working in the old sector, in the declining sector, and clearly you want it to go slower. You just have less of a decline and you stay working there the whole time. But you might also want it to go faster because now you're going to switch to the C sector in your lifetime and start realizing some of the benefits of being there. And so the speed of transition that puts the tip of your triangle, the T-star, at your retirement date is going to be very close, modulo some discounting, some other little things, to the speed of transition that minimizes your lifetime earnings as a result. Yeah, Ben?
So you have these sectors, right? Declining sector and rising sector. But I don't know, actually.
I can hear you.
Suppose you had more sectors. Would you have like 100 sectors? Some of them are falling, some of them are rising. Then it seems like you would really split out that upper envelope, right? Your graph would more look like
yeah. So
much more without that big drop.
So let me 100 is hard for me to think about. Let me think about 3. So with 100, it's very hard to get the sort of conceptual insights. Loosely speaking, you're right, though. So imagine I had a third sector which had just paid a constant outside option that was not valued, it was not subject to the transition, just always constant. We're going to have that in the quantitative model we're going to go through in a second. We're going to have this outside option too. Then what's going to happen in these lifetimes earnings profiles, you can touch this, is that you're going to have a flat region, right? Where you just switch to the outside sector before the C sector rises and becomes sufficiently attractive. But you're still going to ultimately have something that's having a decline, a flat, and then an increase. And therefore, you're still going to. Yeah, it'll depend on the comparative advantage.
A very strong comparative advantage, you're gonna start something forever, even if you have 100%.
Sorry?
If you have very strong comparative advantage in one sector, you're gonna be stuck there forever. Doesn't matter how many other sectors.
Yeah, so let's suppose that you have like psi hat DC and then psi hat DO or something like that, and psi hat DO is very low, then that sector becomes kind of irrelevant for you. So the relevant thing is not the 100 sectors, it's the 3 or 4 sectors that you can maybe apply your skills to. And what's going to end up mattering is kind of how valuable are the skills that are not subject to the transition. And then how does that compare with kind of the longer run level of where the C sector is going to end up? And we kind of have a proof in the paper, and maybe we'll get there. Proof in the paper analytically in this frictionless benchmark that kind of anyone who is going to switch to the C sector in their lifetime under any transition speed, there exists some transition speed in which they would switch to the sectors, will experience these U-shaped kind of phenomena. Because yes, you would flatten that out, but you still are going to have the decline flat up among the relevant sectors that you can apply your skills. Okay. So, yeah, Yucheng.
I guess the kind of the curvature of your U-shape really depends on the curvature of the right-hand side. So in extreme case, if both lines on the like right panel is linear, then actually the U-shape will be almost flat. Right?
No, this is a great thing to bring up. So the S shape that we had is not relevant. In particular, this is going to hold for a linear transition. So what's different? Where's nonlinear linearity coming from? It's coming from the integral of this V, right? It's not coming from the shape of the V per se. So the shape of the V per se, yes, is V-shaped, but that doesn't necessarily, well, it turns out it does, but ex ante it wasn't obvious that that would end up leading to a U-shape in the integral of those V-shapes. And so if you have linear transitions, that integral is still going to non-linearly move and non-monotonically move. The shape itself doesn't matter how much. So yeah, yeah.
Yeah, there's no reason for shifting the transition back and forth, but in a sense like this. So the reason why I'm asking is the fact that these young agents have incentive to wait, right? It's because the earnings that they get later on is the same, right?
So I don't know why they would have an incentive to wait in this frictionless model, because in the frictionless model, you could just go at every instant wherever you are paid the most. And so in this model, there isn't any incentive to wait. In the forward-looking model that we're going to get to in a second, it's actually going to be the opposite. You have an incentive to switch sooner because you're going to realize benefits over time there, and that's an investment decision for you, especially when you have skill accumulation processes. We'll get there. Okay, I want to keep going. So an implication of this is this important political economy consequence, I think. So here what we're plotting is isoquants of your lifetime earnings changes. Now, again, the horizontal axis is the same as before. It's the end data transition. So again, going left is faster. But now the vertical axis are different levels of psi hat for, say, younger workers and for older workers. And then the region is color-coded according to how much that worker type loses from the transition relative to the status quo transition. So darker colors means you lose more, lighter colors means you lose less relative to the status quo, or even maybe benefit relative to the status quo transition. Now that dashed line there is the dividing line between people who are losing from the losing from that counterfactual transition relative to the status quo versus gaining from the counterfactual transition relative to the status quo. So you can see there's a lot of very light colors in the top left corner because they're winning relative to the status quo. And what you can see is that line is kind of upward sloping, which means that as you accelerate the transition, you move further and further left on this plot, a larger range of psi hats are going to start to benefit from the transition speed. What's more, you kind of cross from darker regions to lighter regions as you accelerate the transition. What that means is that on the extensive margin, you might think it would be easier to garner votes if it's just 0-1, do I benefit or not, from accelerating the transition further. But at the same time, that bottom left corner gets darker and darker and darker as you move further and further to the left. So the losses of people who don't switch gets worse and worse and worse on the intensive margin to accelerate the transition. And so the second thing this exercise taught us is that, policymakers might end up facing a trade-off between having more winners on the extensive margin and a thicker tail of losers on the intensive margin. So whether you think the policy is determined by kind of the vocal minority or the marginal benefits is going to have a big effect on how you think this is all going to play out. Okay, so up till now, of course, labor markets have been extremely rudimentary. Hopefully it's been very sort of transparent what's going on. But empirically, we know that unemployment and job ladders are really key for understanding earnings losses after a job displacement. And so motivated by that evidence, we're now going to introduce these labor market frictions and see if they also matter for how those losses change in the pace of the transition. So what we're going to have is a directed search framework, both within and across the different sectors K. There's going to be a standard DMP style matching function where firms are going to post vacancies at a fixed cost. Workers are going to have an opportunity to search for a job at a class on arrival rate lambda U if they're unemployed and lambda E if they're employed. What are they going to be paid? They're going to be paid a constant piece rate pi if they're employed, constant within a job, that is. And if they're unemployed, they're going to get paid a fixed unemployment benefit BU. Because we have on-the-job search, the way this search process is going to work is that you're going to climb up a job ladder. You're going to search first for low piece rates, and then over time, you're going to climb to higher and higher piece rates, completely standard. And so what this means is that when you fall off the job ladder, you could potentially realize large earnings losses. Then to sort of Ben's question, we're going to introduce an outside options sector, which is going to pay a fixed flow benefit BO, which is going to capture all these other sectors that are not subject to the shift. And of course, that's going to be an important parameter. We're going to have to discipline carefully. I'll tell you about that on the next slide. Then we're going to introduce skill accumulation. So we're now going to have general skills that can be applied everywhere and specific skills that can only be applied to the particular sector in which you're employed. They're going to accumulate for the sector you're employed on the job, and they're going to disaccumulate off the job. This is going to allow us to match, realistic scarring effects from being unemployed for a period of time. And side benefit is it means we're also going to be able to match a realistic wage markdown because the value of unemployment is going to be low for these workers. And then finally, we want to reckon with the fact that net flows are a fraction of gross flows in the data. People switch between sectors all the time. And so we're just going to noise up the search process a little bit by introducing both some noise between the sectors, but also some noise within the sectors for the different piece rates. And so that's also going to let us match sort of what share of wage cuts workers receive wage cuts when they have an EE kind of transition. I'll wait for Kasepi.
We're going to have an interesting mechanism without this stuff, which is you may jump into another sector because you know it's going to go. I mean, you may jump early, accept the wage cut to kind of ride that wave, by surf that wave without this stuff.
Yes, that
without the noise.
Without the noise, that will be partially there to match it empirically. We need a little bit of the noise to match the magnitude of the fact that 30% of people get wage cuts when they switch jobs. But you're right that yes, that mechanism will be there once we have the skill accumulation. Without the skill accumulation, I'm not so sure it would be there. Because we don't have well, I guess it would be there very slightly because you want to search for it's an investment that you find a job. That's true. That's true. And you're stuck there for a while because of yes. So that would happen. That would happen. Yep. Skill accumulation is, of course, going to amplify that as well, because then it becomes even more of an investment good. Okay, so we're going to calibrate these extra labor market frictions parameters to a bunch of standard moments, flow rates, unemployment rates, markdown. We're going to match the markdown, as I mentioned, share of wage cuts from the ADP data. I want to pause for a second and talk about this BO parameter because it is important. So if BO were 1, then there's no real scope for losses from this transition. So to calibrate that parameter, we're going to look at workers. We're going to do it with an eye to the climate application. Again, we're going to look at workers who in the CPS were employed in the dirty sector for 4 consecutive months in their first rotation. And then they experience an unemployment spell, and then they go to the outside sector. Again, and we're going to look at the wage changes along those kinds of transitions, both in the model and in the data. And what we find in the data is an 18% decline in wages when undergoing those transitions, which ends up meaning that these BOs are not quite as valuable. Yeah.
What is it again from the dirty set? Now Greg's question, I think, becomes more relevant. How am I thinking about this? Is like the secretary who moves from the dirty sector to the clean sector? Is that what we're identifying here? Or is it the type of person, the precision manufacturing kind of thing? And then now I want to think about occupations and things like that.
So
for the application.
So I think you're I mean, I could choose different values of this BO at this point. I'd say we're still slightly in conceptual land, but that's not your question. So I think what this set of questions, like what is the set of skills that are being displaced in the D sector and rising in the C sector, is really going to be a question of what's the distribution of the psi hats in the economy. And I haven't told you how we're going to get that yet. That psi hat distribution is going to be chosen essentially to match realized reallocation patterns between the D sector and the C sector. And if there's very little reallocation, I'm going to say it's skills are relatively specific. If people are very rapidly moving to the C sector, then that's going to say there's a lot of secretaries or whatever, people who have very transferable skills out there, and it's going to be a distribution of those skills. And so the people who have more transferable skills might be the secretaries, and the people who have more specific skills might be the precision manufacturing workers, I would say. Okay.
Yeah. Can you use the China shock as an external validation?
We're going to have a little bit to say on the external validation, even for the climate transition. I'll get there when we get to the quantitative piece. We could. Papers are getting long as is.
Don't see unemployment rate.
Yeah. We're also not going to have a huge increase in the unemployment rate in our exercise. It's going to end up being pretty much flat, even among our workers who are attached to the D sector. But yeah, it's an interesting thought. Paper's long as is. But I'll have some validation for the dollar numbers a little bit later. Okay. So the first order of business with this model of frictions is just to replicate those nonlinearities and U-shapes. They survive, not surprising. What I think is much more interesting is to do the decomposition of how each of these extra ingredients matter for workers' lifetime earnings changes as we change the speed of the transition. So in the paper, well, here in this picture, we're adding sort of one extra ingredient at a time and seeing which one matters until we reach the full model, which is in black. In the paper, we kind of go through each and every one of these lines and explain how they matter for different types of workers. I don't have time for that. So instead, I want to just focus on the thing that was consistently important, which is the role of these labor market frictions. So I want you to compare now the orange line, which has every ingredient except the labor market frictions, the search both on and off the job, with the purple line, which has search off the job but no job ladders, no on the job search, and the black line, which has on the job search, our full model, people can climb the job ladder. And what you can see is that these frictions actually matter quite a bit for quantifying the nonlinear relationships between the change in earnings and the end date of the transition. So both search and job ladders reinforce these nonlinearities, and the economics, I think, are kind of interesting and subtle in a way. So now, because workers or firms have to post a vacancy to hire workers, that's effectively like a fixed cost of hiring a worker for these firms. And that fixed cost is going to have a nonlinear effect on the job finding rate, which is different throughout the job ladder and different for different kinds of workers. So what happens over time is that the top of the job ladder collapses in D. Firms are not willing to post high piece rates for workers in D because their profits are falling even at a lower piece rate. But it's going to expand slowly and gradually in the C sector. So low side hat workers who are stuck in that D sector are going to lose both because holding fixed their piece rate, the ATDs are falling and they're losing from that. But now also they're going to have lower piece rates over time because the high piece rate jobs aren't being posted for them. Well, the reverse is going to be true for the high side hat workers in the C sector because they can go start switching there. And so what we're kind of finding is that through that sort of job ladder aspect, these labor market frictions matter a lot, and they matter sort of differentially for different kinds of workers in a way that we think is kind of interesting.
If you have heterogeneity within sectors, so what you're saying is that the best manufacturers will stop posting jobs. I would expect the opposite. The good ones will survive, so the top of the job ladder will still be there.
That's right. So we don't have firm heterogeneity, right? So this is all about endogenously widening markdowns, which is, I think, an interesting mechanic. You're right that if we had firm heterogeneity, the best firms would probably survive, and so you get a composition effect there. But that's still going to be killing a lot of the lower type firms, so the probability of finding a job is still going to be lower. Okay, so in my remaining 7 minutes, let me tell you about the quantitative application to the climate transition. So let me just pause and say, I think those first three insights are kind of more broadly applicable, but it's important now to go to a particular, we think, policy relevant application. So what's this application? We're going to think of the economy starting from a stationary equilibrium in 2005. In 2005, for context, in the QCEW, there were about 10 million workers employed in D sectors per the OECD's definition of what a dirty sector is. So it's large. It's about the same order of magnitude as the number of manufacturing workers in 2000 as well. So we still need to estimate two application-specific things. We need to understand the path of the ATKs that's going to hold under the status quo transition. I can't just have sort of fake numbers anymore. And we need to have understand what the distribution of skill endowments and potentially skill accumulation rates are going to look like. So in the paper, we're working, we're almost there, computing the fiscal cost of implementing a particular subsidy paths. and counting for these other workers, but that's not going to be the focus here. So let me move on. Okay, so how are we going to discipline the A's? Well, in our model, workers are going to be paid a piece rate of their production. You have a question? Yeah.
Can I return to Adrian's question now on the application? So does it matter whether or not what's driving the ATKs here? So whether it's a preference or actual productivity?
Does it matter? So we're going to take it as preferences. I think an old version of our paper had like an innovation block, which led the productivities to be moving over time. The whole analysis of having, I don't think it's going to matter at all, because essentially that's just going to, again, be encoded in the A's. And there's a question of how we discipline those A's. But I think it's all going to, and even in the, productivity moving around, the government can implement faster paths through its subsidies. So I don't think it ends up mattering. But we can talk offline. So how are we going to discipline the path of the A's? Well, the wage changes of job stayers in this model, if you're a job stayer, you have a fixed piece rate. And so therefore the wage changes in job stayers is going to reflect your skill accumulation and the change in the A's over time. So what we're going to do is we're going to take wage changes in the CPS over 12 months for job stayers. We're going to residualize that a bunch of number of fixed effects, education, sex, and age, trying to account for these differential, human capital accumulation aspects. And think of the leftover variation in the ATDs across the sectors, or in the wage changes across the sectors, is reflecting variation from the A's. And so that's what those dots are, is kind of what the empirical, quote unquote, raw A's would look like in sample. And then we have to kind of project out what's going to happen after that. And we're going to have two scenarios that we're going to consider. First is simple, just draw a line of best fit and extrapolate it out to 2060. Another is to allow for the transition to pick up in the coming years following this S-curve kind of dynamics. And we're going to fit the S-curve to match the data in sample. And then we can, given these A's, we can estimate the distribution of these psi hats and the skill accumulation. So how are we going to do that? Well, think about the frictionless benchmark. The share of workers who are going to reallocate at any given moment in time is going to be exactly the share of workers who have sufficiently high psi hat to compensate them for the differences in the A's. And so given realized reallocation and some knowledge about the A's, which I just told you how we get, we can trace out the G in the frictionless benchmark. Now, in the full model, it's much more complicated, but the same idea applies. What's more is now in the full model, there's going to be differential age gradients of this reallocation pattern. Why? Because older workers will have spent more time in the D sector before the transition begins, accumulating skills there, and are going to switch at a lower rate, exactly as in the data. So we can use that age gradient to kind of estimate the skill accumulation rate as a result. And so this is a big model, but we can estimate this whole thing through simulated method of moments because of the block recursivity of these directed search models. So let me just sort of show you how that looks. The solid black line there is the data reallocation from D to C among these incumbent workers in D. And then each of these dotted lines corresponds to a different psi hat endowment, the reallocation of a different psi hat endowment in the model. And because of block recursivity, we can solve out for those different dotted models without dotted reallocation rates without knowing the distribution itself. And so then the estimation problem is just to choose the weights on those dotted lines in order to best match the data. And so we're going to do that in two ways. We're going to try it, assume that they're drawn from a Frechet distribution or assume that they're drawn from a long normal distribution, as is kind of standard in a lot of these literatures. They both give close and similar fits. What I'm plotting here is the distribution of psi hats in 2025 from the Frechet distribution. And so it seems like a lot of people do have relatively specific skills that we rationalize through. Given the wage changes, there's not all that much reallocation. There's some, but not a lot in this period. Okay. And we estimate, a skill accumulation rate, which is kind of in the range from Kambor-Romanowski. All right. So okay, 2 minutes. Perfect. I have two things to do with this quantitative quantified model. The first is to think about what the cumulative losses from the status quo transition have been between 2005 and 2025. And what we estimate is that these incumbent workers lost around 5.5% of their lifetime remaining income, but there's large heterogeneity across those losses. Is that a big number or a small number? Well, it's around the same order of magnitude as losses people estimate from import competition. So lots of ink spilled on that. So it seems relatively large in some sense. We can also put it into dollar terms. This corresponds into about 1 year of lost labor income. So times the $67,500 of average income in the D sector in 2005, times the 10 million workers there, that adds up to about $672.5 billion of lost labor income as a result of this this decline in the dirty industry or the climate transition from 2005 to 2025. And we can validate that against some of the QCEW losses, and they're in the same sort of ballpark already. One small thing, you can compare the full model to the frictionless model, and you find much larger losses and more dispersed losses in the full model, reflecting the economics we already discussed. The next thing we can do is these counterfactual questions. What if we were to accelerate to a 2050 transition in gray or a 2040 transition in white? And what we find indeed is that a faster transition leads to there being more mass to the right of zero, but a thicker left tail of losses, as we sort of previewed before. The 2050 transition is going to lead extra losses of up to about a half a year of average earnings. This is under the linear transition. It's a little bit bigger with S shapes. And putting that into dollar terms, that means the total earnings losses in addition for the losers from accelerating to 2050 is $71.5 billion. So that's a lost labor income if we were to, among these incumbent workers, focusing on the losers if we were to accelerate to 2050. And of course, it's bigger at 2040. The unconditional losses, if you include the people who are winning, are much smaller. So it's, $26 billion for 2050. So what that implies, that's, costly, but I would say it's small relative to the social cost of carbon estimates. And what it means is that the challenge for the politics of this sort of transition is not really going to be how can we help the average detached workers, but how can we sort of make sure that these really vocal losers are going to be adequately compensated to be brought on board with this. So I'll conclude there. Thanks a lot for all the questions and comments.